On May 25th, 2026, a quiet Sunday, something happened that most Americans completely missed. Iran signed it, not a rumor, not a leaked document, an actual deal, a 60-day ceasefire agreement between the United States and Iran. And buried inside that agreement was one sentence that changed everything for precious metals investors. The Strait of Hormuz would reopen. Let that sink in for a second. The Strait of Hormuz, the single most important waterway on this planet. 20% of the world's entire oil supply flows through that narrow strip of water. For months, Iran had it choked. Mines in the water, warships at the entrance, oil tankers rerouted thousands of miles, energy prices through the roof. And just like that, ships started moving again. Within hours of the news breaking, oil dropped 2-week lows. Brent crude fell below $100 a barrel. U.S. crude was heading toward the low 90s. Traders were dumping oil futures faster than you could refresh your screen. But here's where it gets interesting. And this is what the mainstream financial media completely missed in their oil crash coverage. Silver went up, not down, up. Silver climbed to $77.80 on the session, a 3% move in a single day. And by Monday morning in Asian trading hours, silver was pushing towards $78.50. That is not a coincidence. That is not random market noise. That is the market telling you something very specific about what this deal actually means. Most people look at the Iran deal and think, great, oil is cheaper, crisis over, move on. They don't understand the chain reaction that just started. Because the Iran conflict wasn't just an oil story, it was an inflation story, it was a Federal Reserve story, and it was, quietly, a silver story. One that has been building for months while most retail investors were staring at their stock portfolios wondering why nothing was working. Let me break this down properly, because the numbers here are staggering. Back in January 2026, silver hit an all-time high of $121.64 per ounce. That wasn't hype. That wasn't a bubble. That was the real market telling you that demand for silver had hit a structural breaking point. Industrial demand, investment demand, and institutional accumulation all colliding at exactly the same time. Then February 28th happened. Iran conflict began. Strait of Hormuz closed, oil prices surged, and suddenly inflation fears that everyone thought were behind us came roaring back. The Federal Reserve, which had been widely expected to cut rates in 2026, started making noises about holding, maybe even hiking. Silver fell from $121 all the way to $67 by late March, a 44% drop in less than 2 months. That is historic volatility, that is fear, panic, and leveraged selling all happening simultaneously. But here's what the charts don't show you. Here's what the price data misses entirely. The physical market never stopped buying. While paper silver was being sold on the futures exchanges, physical silver, actual bars, actual coins, actual industrial contracts, was being accumulated quietly, steadily, by the same buyers who have been right about silver every single time the Western financial press called the move over. And now, with the Strait of Hormuz reopening, the single biggest headwind to silver's recovery just got removed. Here's what the oil crash actually means for silver, and why Wall Street is only telling you half the story. When oil prices fall sharply, like they did on Monday, dropping to 2-week lows, it creates a very specific chain reaction in global financial markets. Most people only see the first link in that chain. Cheaper gas, lower energy bills. That is the consumer story. It is real, but it is surface level. The deeper story is what happens to inflation expectations. For the past several months, oil above $100 a barrel had been the primary driver of elevated inflation readings. Energy feeds into everything: transportation costs, manufacturing costs, food production costs. When oil stays high, inflation stays high. And when inflation stays high, central banks, when the Iran deal was announced and oil started dropping, inflation expectations started falling. Not dramatically, not overnight. But the direction changed, and in financial markets, direction is everything. The Federal Reserve had been in an impossible position. Inflation stubbornly above target because of energy prices, growth slowing, labor market softening. They could not cut rates without looking like they were surrendering to inflation. They could not hike without risking a recession. So they sat there, frozen. The Iran deal just gave them a way out. If oil stabilizes in the $85 to $90 range, which is where futures markets were pointing by Monday afternoon, inflation readings for June and July will start coming in lower. Lower enough that the Fed can start talking about cuts again without losing credibility. And the moment the Fed starts cutting, or even strongly signaling cuts, silver moves. Fast. This is not speculation. This is how silver has behaved in every major rate cycle of the past 40 years. When real interest rates peak and start declining, silver outperforms virtually every other asset class. Not because of some mystical monetary theory, because of simple math. The opportunity cost of holding silver decreases while industrial and investment demand continues to grow. Now let us talk about the price itself. Silver at $78 sounds high if you are comparing it to 2 years ago, but you have to look at it in context. Silver's year-over-year performance as of mid-May 2026 was 173%. For a commodity with the demand fundamentals silver has right now, that is a rational repricing, not a bubble. The gold to silver ratio, the number of ounces of silver it takes to buy 1 ounce of gold, is currently sitting around 55 to 1. The historical long-run average is 47 to 1. In the 2011 bull market peak, it compressed to 31 to 1. In the COVID crash of 2020, it spiked to 125 to 1, the most extreme silver undervaluation in modern market history. At 55 to 1, silver is still cheap relative to gold. The direction of that ratio right now, with oil falling and Fed expectations shifting, is lower, which means silver is moving into outperformance mode. Goldman Sachs has a 2026 average target of $85 to $100 for silver. Citigroup's second half 2026 target is $110. These are not fringe analysts. These are institutions that manage trillions of dollars in assets. But here is the number that nobody is talking about in the mainstream press. The number nobody is talking about is $309. Bank of America published a research note in April 2026 with a year-end silver target range of $135 to $309. That is not a typo. $309 per ounce of silver by December 31st, 2026. Buffet called this a scenario analysis, not a base case. The $309 figure represents a ratio compression scenario. Specifically, what happens if the gold to silver ratio compresses toward historic extremes. Most serious analysts do not expect that outcome. But the fact that a major Wall Street bank ran that math and published it tells you something critical about the structural forces building underneath silver right now. Buffet does not publish research that makes them look foolish. They publish that number because the inputs, the demand data, the supply deficit numbers, the industrial consumption trends, actually support a scenario where silver moves that dramatically. So what are those inputs? First, supply. The Silver Institute's most recent data shows a structural supply deficit in the silver market for the third consecutive year. Global silver mining output is not keeping pace with demand. And, unlike gold, silver cannot be easily substituted in its industrial applications. You need silver in solar panels, you need silver in electric vehicle components, you need silver in 5G infrastructure, you need silver in semiconductor manufacturing. The AI build-out alone, data centers, cooling systems, advanced chips, is consuming silver at a rate that most analysts did not model 3 years ago. This is not a future trend. It is happening right now. It is in the consumption data today. Second, investment demand. Central banks globally have been quietly increasing their exposure to hard assets. Silver, through various structured products and sovereign wealth fund vehicles, has been seeing institutional accumulation at levels not seen since the early 2010s. Third, the angle almost nobody in Western financial media is covering, mining company earnings. When silver prices are elevated and stable, mining companies become extraordinarily profitable. Their margins expand dramatically. When mining margins expand, institutional investors start buying the equities, which creates another wave of capital flowing into the silver complex. This is the flywheel. Higher prices attract institutional attention. Institutional attention brings retail capital. Retail capital drives prices higher, which attracts more institutional attention. But here is the honest risk picture, because this channel does not hide the downside. The Iran deal is not fully signed. Let us be precise about this. As of Monday morning, the US and Iran are close to signing. There's a proposed agreement. There's a framework. But Iran's state media reported the US government is still blocking certain clauses, specifically around the release of frozen Iranian assets. The strait may not be fully open yet. Oil did not fall $15 overnight on certainty. It moved lower on optimism, on probability. And silver's 3 to 4% move on Monday reflects that same probability pricing. If talks break down, if Iran walks away or the US adds conditions Iran will not accept, oil goes back up. Inflation expectations go back up. Fed rhetoric tightens again, and silver gives back some of these gains. That is the honest risk scenario. Any investor who does not have that in their framework is not investing. They are gambling. So where does silver go from here? Let us look at what the data actually tells us. Short term, silver is in a technically strong position. After bottoming near $67 in late March, a 44% collapse from January's all-time high, silver has staged an impressive recovery back above $78. That is a 16% move from the lows. And it happened against a backdrop of still elevated interest rates and an unresolved geopolitical situation. That is a strong recovery relative to the headwinds in place. The key level to watch is $80. Silver has approached $80 twice in recent weeks and pulled back both times. A clean break above $80 Sustained, not just an intraday spike, would likely trigger significant algorithmic buying from systematic trend-following funds. That alone could add $3 to $5 to the price in a matter of days. Medium term, the setup depends on three variables. Variable 1, the Iran deal. If a 60-day ceasefire with Hormuz fully reopened is confirmed and holds, oil stabilizes lower, inflation cools, and the Fed gets room to signal rate cuts. That is the bull case. Silver targets $90 to $100 by end of Q3. Variable 2, Federal Reserve communication. The next FOMC meeting is June 16th and 17th. If Fed language shifts to anything that hints at a September cut, silver will move before the actual cut happens. Markets price the future, not the present. Variable 3, physical demand continuation. If industrial consumption data, particularly from solar manufacturers and AI infrastructure build-out, continues running ahead of projections, the supply deficit widens further. That is a floor under the price, regardless of what the Fed does or what happens with Iran. The long-term picture is the clearest of all. Because this is not just about geopolitics or interest rates. Silver is a 21st century industrial metal. The green energy transition is not stopping. The AI infrastructure build-out is not stopping. The electrification of transportation is not stopping. Every one of those megatrends consumes silver in quantities that were not modeled into price forecasts 5 years ago. The Silver Institute projects that industrial demand will represent over 60% of total silver consumption by 2027. That means silver's price is increasingly being set not by investor sentiment, but by whether factories can source enough physical silver to keep their production lines running. That is a fundamentally different market dynamic than what existed in 2015 or even 2020. And it means the volatility you have seen, the spike to $121 in January, the crash to $67 in March, the recovery to $78 today, is not randomness. It is a market in the process of finding a new, higher equilibrium. The smart money figured this out months ago. The institutions have been building positions. The physical market has been tight. And now, with the Iran deal potentially removing the biggest overhang on the entire precious metals complex, the signal is getting harder to ignore. Silver at $78 is not cheap by historical standards, but it may be very cheap by 2027 standards. The question is not whether silver goes higher. The question is whether you understand the mechanism well enough to hold through the volatility, through the pullbacks, the false starts, the days when headlines make everything look terrible, and come out on the other side with a position that actually matters. Invest with logic, not hype. OG out. Right now, silver is sitting at $76 an ounce. And most people in the West think that's just fine. Nothing to worry about. Maybe a little dip, maybe just the market cooling off after a big run. Move on. But here's what they're not telling you. Two of the most powerful nations on Earth, China and India, have both slammed the door shut on silver. Not at the same time by coincidence, not by accident. Within 6 months of each other, the world's largest silver refiner and the world's largest silver consumer both restricted the flow of physical silver across their borders, and silver is still at $76. Let that sit for a second. Because what you're watching right now is not a dip, it's not a correction. What you're watching is the early stage of one of the most significant supply squeezes in the history of the silver market. And the majority of Western investors have absolutely no idea it's happening. My name is OG, and this is the Asian guy. Let's go back to January 1st, 2026. While most Americans were recovering from New Year's Eve, Beijing was quietly implementing one of the most consequential policy shifts in global commodities. China, a country that mines roughly 13% of all silver on Earth, but refines between 60 and 70% of all silver traded globally, replaced its silver export quota system with a strict licensing framework. Overnight, silver exports became limited to just 44 state-approved companies. Read that again. 60 to 70% of the world's refined silver flows through China. And China just put a lock on the door. Now think about what that actually means for the global supply chain. It doesn't matter how much silver is sitting in the ground in Mexico, Peru, or Australia. If it can't get refined and distributed at scale, it doesn't reach the market. China is not just a producer in this story. It couldn't keep up. And investment demand was surging as inflation fears and dollar concerns pushed more and more people toward hard assets. Into that environment, already tight, already stretched, China dropped a licensing bomb. But that's only half the story. Because 4 months later, India moved. India is the single largest consumer of silver on the planet. The country imports over 90% of the silver it uses. Last fiscal year alone, India's silver imports hit $12 billion, up from $4.8 billion just the year before. That's not a small number. That's a doubling of silver import spending in 1 year. driven by a combination of jewelry demand, industrial use, and an exploding retail investment market where millions of everyday Indians are buying silver as a store of value. And in May 2026, India hiked its silver import duty from 6% to 15% and restricted the majority of silver imports coming into the country. Two countries, both shut, silver at $76. And here in the West, the conversation is still about whether the Fed is going to cut rates in September. Let's talk about why China did this, because the Western financial media covered it for about 48 hours and then moved on. But if you understand what China is actually doing here, this story gets a lot more serious very quickly. China's relationship with silver is unlike any other country in the world. It's not just a consumer, it's not just a miner. China sits at the center of the entire global silver supply chain in a way that most investors in the West genuinely don't understand. Here's how it works. Silver is mined all over the world, but raw silver ore is not the same as market-ready silver. Before silver can be sold, traded, used in solar panels, or turned into investment bars, it has to be refined. And China has spent the last 2 decades building the most dominant silver refining infrastructure on Earth. That 60 to 70% refining figure is not an exaggeration. It is the documented reality of how global silver markets function in 2026. So when Beijing shifted from an open quota system to a licensing framework restricted to 44 approved companies, they didn't just slow down exports. They created a mechanism for complete centralized control over how much refined silver leaves China. And when, and to whom. Now ask yourself a simple question. Why would China do that? There are 2 possible answers. The first is protectionist economics. China wants to ensure domestic supply for its own industrial needs. China's solar manufacturing industry is the largest in the world. Its electric vehicle production is the largest in the world. Its AI infrastructure build-out is consuming copper, silver, and rare earth materials at a pace that even Chinese planners are scrambling to manage. Keeping silver inside Chinese borders means keeping Chinese factories running. The second answer is more strategic, and frankly, more alarming. Silver has historically been a monetary metal. Central banks across the Eastern world have watched the United States print trillions of dollars, watched Moody's strip America of its last AA credit rating in May 2025, watched the dollar weaken, and watched gold climb from $3,200 on the day of that downgrade to over $4,150 today, a 40% gain in 12 months. Gold has been the headline, but silver is the sleeper. At the current gold to silver ratio of approximately 55 to 1, silver is historically cheap relative to gold. The long-run average ratio across the 20th century was 47 to 1. Analysts at Bank of America have a published price target of $309 for silver. Citigroup's second half 2026 target is $110. Goldman Sachs projects an $85 to $100 average for the full year, and yet silver is sitting at $76. That gap between where silver is and where major institutions say it should be, that gap is the opportunity that China appears to be positioning around. Because here's what the licensing framework effectively does. It gives Beijing the ability to turn the silver export tap on and off at will. When global silver prices rise to levels China considers favorable for their domestic industry, favorable for their strategic reserves, favorable for their negotiating position in a world where the dollar's dominance is being questioned, China can open the tap. Until then, the tap stays mostly closed. Western investors are sitting on their hands waiting for a Fed announcement. Meanwhile, Beijing is quietly becoming the gatekeeper of the most industrially critical precious metal on the planet. And the price? Still $76. The market hasn't priced this in yet. That's the window. Now let's talk about India, because this is where the story goes from alarming to genuinely historic. India's relationship with silver is different from China's. China controls supply, India drives demand, and the scale of that demand is something most Western investors have never had to think about because it never showed up in their Bloomberg terminals until it was too late to ignore. India is the world's largest silver consumer. Full stop. The country imports over 90% of the silver it uses because domestic mine production is minimal, and in the fiscal year leading into 2026, India's silver import bill hit $12 billion, nearly triple what it was just 2 years prior. That explosion in demand is being driven by 3 forces working simultaneously. First, jewelry and cultural demand. Silver is woven into the fabric of Indian society in a way that has no Western equivalent. Wedding season in India doesn't just move gold prices, it moves silver prices. Religious festivals, household gifting, temple offerings. Silver is embedded in Indian culture at every economic level. And as India's middle class grows, projected to reach 500 million people by 2030, the number of households buying silver every year grows with it. Second, industrial demand. India's manufacturing sector is expanding aggressively. Electronics production, solar panel assembly, EV battery components, all of these require silver. The Indian government's push for domestic manufacturing under its production-linked incentive schemes means more factories, more industrial silver consumption, and less dependence on imported finished goods. Third, and this is the part that should get every silver investor's attention, retail investment demand. Millions of everyday Indian investors are buying silver coins, silver bars, and silver ETFs as inflation hedges. In a country where a significant portion of the population still doesn't fully trust paper money, where gold and silver have been savings vehicles for generations, the shift towards silver investment is not a trend. It's a structural transformation. With Brent crude above $100 due to ongoing Middle East conflict and the rupee already under pressure, New Delhi decided it needed to slow the outflow of dollars. But here's the consequence nobody's talking about. India can restrict how much silver comes in. India cannot restrict how much silver its population wants. That domestic demand doesn't disappear when import duties go up. It goes underground. It creates premiums. It creates scarcity within the world's largest silver-consuming nation. And now combine both moves. China has locked down 60 to 70% of global silver refining capacity. India has restricted imports into the world's largest silver-consuming market. The global silver market was already running a structural supply deficit before any of this happened. The Silver Institute projected a 30 million ounce deficit for 2026, even under normal conditions. These are not normal conditions. What you have now is a compression from both ends. Supply is being choked at the refining stage. Demand is being trapped inside the world's largest consuming nation. The physical silver that does reach international markets is going to face pressure from every direction. And Western investors are still asking whether silver is better than a high-yield savings account. The East isn't sleeping. The East built the cage. The West just hasn't noticed the door is closed. So what does this actually mean for the silver price? Let's get into the numbers. Because this is where the East versus West disconnect becomes impossible to ignore. Silver today is $76 an ounce. 1 year ago, silver was trading below $35. That's a gain of over 117% in 12 months. On the surface, that sounds like silver has already had its big run. And that's exactly what most Western retail investors think. They look at a chart, they see a metal that's more than doubled, and they think they missed it. But here's what the institutions are actually saying. Bank of America has a published price target of $309. Not $100, not $150, $309 per ounce of silver. Their thesis is built on one word: shortage. Physical shortages of silver so severe that the paper price and the physical price disconnect, that the market is forced to reprice silver at a level that reflects real-world scarcity rather than futures contract speculation. Citigroup's second half 2026 target is $110. Goldman Sachs projects an average of $85 to $100 for the full year. The Reuters survey of 30 analysts puts the median target near $79.50. And that survey was conducted before India's import restrictions were announced. Every single one of those targets is above $76. The market is not pricing in what China did in January. The market is not pricing in what India did in May. The market is running on momentum from the Trump-China summit in mid-May, which briefly pushed silver above $88 before Iran tensions pulled it back. And now it's drifting at $76, while the actual structural story beneath the surface gets more serious by the week. Here's the math that should make every silver investor stop and think. The gold to silver ratio right now is approximately 55 to 1, meaning it takes 55 ounces of silver to buy 1 ounce of gold. The historical average across the 20th century was 47 to 1. At the peak of the 2011 silver bull market, that ratio compressed all the way to 31 to 1. If the ratio simply returns to its modern average of 55 to 1, which it already basically is, silver needs to track gold. Gold is at 4,150. A 47 to 1 ratio puts silver at $96. A 31 to 1 ratio, the 2011 peak, put silver above $140, and we haven't even gotten to the Bank of America scenario. What we are watching in real time is a market that is structurally broken in ways the spot price hasn't yet admitted. The physical supply chain is being controlled at the refining end by Beijing. The demand side is being artificially compressed by New Delhi's import restrictions, which creates pent-up demand that will release eventually, and when it does, it releases hard. The West is focused on Fed meeting minutes and Treasury yields. The East is building walls around the most industrially essential precious metal on the planet. Silver at $76 is not the story. Silver at $76, while China controls the refining and India suppresses its own demand. That is the story. Because both doors are shut. The silver that was supposed to flow freely through global markets is being held at both ends. And when those doors open again, whether by policy reversal, geopolitical shift, or simple market pressure, the price that silver trades at will look nothing like $76. The window is open right now. The question is whether you're paying attention. Invest with logic, not hype. OG out. Silver just crashed. Not a dip, not a pullback, a crash. In less than 48 hours, silver went from $76 an ounce to $73, wiping out weeks of gains in a single move. And right now, across trading desks in New York, London, and Shanghai, one question is dominating every conversation. Is this the buy signal smart investors have been waiting for, or is this the beginning of something much worse? That is exactly what we are going to break down today. No fluff, no hype, just the raw data, the real forces, and what history tells us happens next. Let's start with the number that shocked the market. $73. That is where silver is sitting right now. To put that in perspective, just 1 year ago, silver was trading around $33 an ounce. That means even after this crash, silver has still delivered a 120% return in 12 months. 120%. That is not a bad investment. That is a life-changing move for anyone who positioned early. But here is the thing about markets. They do not care about your profits. They do not care about your timeline. And right now, the market is sending a signal that has every precious metals investor on edge. Gold is currently trading around $3,300 an ounce. The gold to silver ratio, which tells you how many ounces of silver it takes to buy 1 ounce of gold, is sitting at approximately 45. Historically, when this ratio spikes, it means silver is underperforming gold. And right now, silver is getting hit harder, faster, and with more force than gold. Why? Because silver is not just a precious metal, it is an industrial metal. And when fear enters the market, fear about growth, fear about manufacturing slowdowns, fear about demand destruction, silver takes the hit first, gold holds its ground, silver bleeds. That dual identity, part inflation hedge, part industrial commodity, is both silver's greatest strength and its biggest vulnerability. And right now, that vulnerability is being exploited. Here is what actually triggered this crash. It started with oil. The Strait of Hormuz, the narrow passage through which roughly 20% of the world's oil flows, has been disrupted by the escalating US-Iran conflict. The IEA described this as the largest energy supply shock on record. Oil prices spiked, and when oil spikes, inflation expectations spike with it. Now here is where it gets counterintuitive. Silver is supposed to be an inflation hedge. So why is inflation fear crashing silver? Because of interest rates. When inflation expectations rise, central banks respond by keeping rates higher for longer, or even raising them further. And silver, like gold, is a non-yielding asset. It pays you nothing. No dividend, no coupon, no interest. When rates are high, investors rotate out of non-yielding assets and into bonds and cash. That selling pressure is exactly what we're seeing in the silver market right now. The Federal Reserve is meeting this week. Markets are expecting rates to hold steady, but the language, the tone coming out of that meeting, could be what determines whether silver finds a floor at $73 or continues its descent towards $60 or even $65. And there is one more layer to this story that almost nobody is talking about. This could be Jerome Powell's final meeting as Federal Reserve Chair. Think about that for a second. The man who has guided monetary policy through one of the most turbulent economic periods in modern history may be stepping down. That kind of institutional uncertainty does not calm markets. It rattles them. And rattled markets sell first and ask questions later. Silver is caught in the middle of all of this. A geopolitical crisis, a central bank in transition, oil prices at 4-year highs, inflation running hot, and a precious metal that has already delivered 120% returns sitting at a price point where the next move could be either a historic buying opportunity or a trap. The data will tell us which one. And that data is what we are going to examine right now. Let's talk about what the charts are actually showing us, because the price action over the last 2 weeks tells a very specific story. On April 17th, silver hit a high of $81 an ounce. That was the peak. The moment when momentum was at maximum, when retail investors were piling in, when headlines were screaming about silver going to $100, when the fear of missing out was at its most intense. Then the reversal began. $81 became $78. $78 became $76. And then in a single session this week, silver dropped over 3% to close at $73. That is an $8 move to the downside in under 2 weeks. In percentage terms, that is nearly a 10% correction from peak to current price. Now let's compare that to gold. Gold went from approximately $3,500 at its recent peak to around $3,300 today. That is a 5.7% correction. Silver corrected nearly twice as hard as gold in the same time frame. That divergence is critical data. It tells us that institutional money, the big funds, the hedge funds, the commodity trading advisors, is rotating out of silver faster than gold. And when institutions move, they move with size. They move markets, and they are moving right now. But here's where the story gets interesting. Asia is not selling. Now, while Western markets are dumping silver, Asian buyers, particularly in China, India, and across Southeast Asia, are paying record premiums to get their hands on physical silver. The premium on physical silver in Asian markets has hit levels not seen in years. That means even as the paper price on COMEX falls, real people with real money in real markets are paying more, not less, for the actual metal. This disconnect between paper price and physical demand is something that every serious precious metals investor needs to understand. The spot price you see on your screen is determined by futures contracts. Paper promises to deliver silver at a future date. It is not always a perfect reflection of what the physical market is doing, and right now the physical market is telling a very different story than the futures market. Let's bring in the macro context. The US CPI, the Consumer Price Index, came in at 3.3% year over year for March 2026. That is the highest inflation reading since 2024. The IMF has cut its global growth forecast to 3.1% for this year and explicitly warned that if the Middle East conflict continues to escalate, global growth could slow to 2.5%. That is getting dangerously close to recession territory. Stagflation. That word is back. Stagflation is the toxic combination of high inflation and low growth. It is the worst possible environment for policymakers because the tools you use to fight inflation make growth worse, and the tools you use to stimulate growth make inflation worse. You're caught in a trap. And historically, look at the 1970s and early 1980s. Stagflation is one of the most powerful environments for precious metals. Gold went from $35 an ounce to $850 an ounce during that period. Silver went from under $2 to $50 an ounce. Those are not typos, those are historical facts. Now, we're not saying history repeats exactly. But when the macro environment starts rhyming with 1979, oil shocks, geopolitical conflict, central bank credibility under question, stagflation fears, precious metals, investors pay attention. The Bank of Japan just held rates in a split vote. The ECB is expected to pause, but signal future tightening. The Bank of Canada is under pressure. Every major central bank is navigating the same impossible terrain: high energy prices, stubborn inflation, and slowing growth. Gold at $3,300 is reflecting that fear, but silver at $73, after correcting almost 10% from its recent high, raises a specific question that every investor needs to answer for themselves. Is $73 the new floor, or is it a trapdoor? The answer lies in understanding who is actually buying right now, and more importantly, who has been buying for the last several months without anybody noticing. Here's a number that should stop you cold. In the first quarter of 2026, silver ETF inflows hit their highest level since 2020. Institutional investors added hundreds of millions of dollars worth of silver exposure in just 3 months. At the same time, COMEX registered silver inventories have been declining. Physical silver is leaving the vaults. Let that sink in. Paper silver is being sold on the futures market, driving the spot price down. But physical silver is simultaneously leaving storage at an accelerating pace. These two things cannot coexist indefinitely. Eventually, the physical reality catches up to the paper price. This is not speculation. This is what happened in 2020 and 2021 when silver surged from $12 to $30 in under a year. It is what happened in 2011 when silver touched $50. In both cases, there was a period of paper price suppression followed by an explosive move higher when physical demand overwhelmed the system. Now, let us be very clear. We are not telling you silver is going to $100 next week. Anyone making that kind of promise is selling you something. What we are telling you is that the structural setup, declining inventories, record Asian premiums, institutional inflows, and macro tailwinds, is consistent with conditions that have preceded major silver rallies in the past. But what about the risk? Let's talk about the downside scenarios, because intellectual honesty demands it. If the Federal Reserve signals an extended rate hold, or worse, a rate hike, at this week's meeting, silver could see further selling pressure. The next key support level below $73 is around $68. Below that, the $62 to $65 zone, which was a major resistance level that silver broke through on the way up, could become the next major test. If the US-Iran situation moves toward de-escalation, oil prices could fall, inflation expectations could ease, and the urgency that has been driving safe haven demand for precious metals could diminish. That would be a headwind for both gold and silver in the short term. And if global economic data continues to weaken, if we start seeing serious deterioration in manufacturing, in employment, in consumer spending, then silver's industrial demand story takes a hit. Remember, silver is used in solar panels, in electronics, in medical devices. A global slowdown means less of all of those things being produced. So the bear case is real. It has to be acknowledged. But here's what the bull case looks like. The U.S. military, according to recent reports, has already consumed a significant portion of its most advanced missile stockpiles due to ongoing conflicts. Rebuilding those stockpiles requires, among other things, silver. Silver is a critical component in defense electronics, guidance systems, and communications equipment. Military demand for silver is not going away. The global energy transition, solar panels, electric vehicles, battery storage systems, requires enormous quantities of silver. The Silver Institute projects that industrial demand for silver will set records in 2026 for the third consecutive year. This is structural demand that does not care about short-term price movements. And then there is the currency story. The US dollar has been strong recently, which is part of what is putting pressure on silver prices, but dollar strength cannot last forever. Not when the US is running trillion-dollar deficits, not when global trading partners are actively diversifying away from dollar-denominated assets. When the dollar eventually weakens, commodities priced in dollars, including silver, benefit directly. Gold at $300 an ounce and silver at $73 gives a gold-to-silver ratio of approximately 45. The historical average of this ratio over the past century is closer to 55 to 60. Below 45, silver is relatively expensive compared to gold. This ratio is one data point, but it is a data point that sophisticated investors track carefully. The question every viewer needs to answer is this: are you looking at silver through a 6-week lens or a 6-year lens? Because depending on your time frame, $73 looks like a catastrophe or an opportunity. Let us talk about what smart money is actually doing right now, because the retail narrative and the institutional reality are two very different things. When silver dropped 3% this week, retail sentiment on social media went negative almost immediately. Reddit threads filled up with panic. YouTube comments asked whether the bull run was over. Google searches for silver crash spiked. Fear dominated the conversation. Meanwhile, some of the largest commodity funds in the world were quietly adding to their positions. This is not unusual. In fact, this is the pattern. Every major commodity rally in history, oil in the 2000s, gold post-2008, silver in 2020, has been punctuated by violent corrections that scared retail investors out of their positions right before the next leg higher. Institutions use those corrections to accumulate at lower prices. Retail investors sell at the bottom and then buy back in at the top, and then wonder why they never make money. Understanding this cycle does not guarantee you profits, but not understanding it almost guarantees you losses. Here's the current picture painted by the data. Gold, approximately $3,300 per ounce, down from its recent high of $3,500, but still up over $1,000 from 1 year ago. Silver, $73 per ounce, down from the recent high of $81, but still up over $40 from 1 year ago, representing a gain of more than 120% in 12 months. The gold-to-silver ratio, approximately 45, indicating silver has outperformed gold significantly over the past year, though it has given back some of that outperformance in this recent correction. COMEX silver inventories, declining steadily. Asian physical premiums at multi-year highs. ETF inflows, at their highest since 2020. Industrial demand forecast for 2026, record-breaking for the third consecutive year. Federal Reserve policy, rates on hold, but language expected to remain hawkish. U.S.-Iran conflict, unresolved, with oil prices elevated and inflation running at 3.3%, above the Fed's 2% target. IMF, global growth forecast, cut to 3.1%, with downside risk to 2.5% if the conflict escalates. This is the environment silver is operating in. It is complex. It is volatile. It is not for investors who need certainty. Precious metals markets reward patience, conviction, and the ability to separate short-term noise from long-term signal. The question that opened this video, is $73 a buy signal or the beginning of the end, does not have a single answer. It depends on your position size, your time horizon, your risk tolerance, and your understanding of what silver actually is. If you are a short-term trader, this volatility is a tool. The $68 support level and the $78 to $81 resistance zone are your boundaries. Play the range or stay out. If you are a long-term investor, someone who believes that dollar debasement, industrial demand growth, and geopolitical instability are structural trends that are not going away, then $73 silver, after a 120% run, pulling back nearly 10% from its peak, looks like one thing and one thing only: an opportunity, not a guaranteed one, not a risk-free one, but an opportunity grounded in data, supported by historical precedent, and aligned with macro forces that are unlikely to reverse in the near term. Here's the final thought. Every major silver rally in modern history began with a period that felt exactly like this. uncertain, volatile, uncomfortable. The investors who profited were not the ones who waited for certainty, because certainty never came. They were the ones who did the research, understood the risk, sized their position appropriately, and had the discipline to hold. Whether you agree with that framework or not, at least now you have the data to make your own decision. And that, making decisions based on logic, based on evidence, based on real market data rather than emotion and hype, is what this channel is about. Invest with logic, not hype. OG out. Here's what nobody told you. On a quiet Friday morning, while most Americans were checking their coffee and scrolling their phones, a three-letter word that took over a century to earn just died. AAA gone. Moody's, the last of the big three credit agencies to hold America at the top, finally pulled the trigger. The United States of America is no longer a or-rated country. They dropped it to A01, and if you think that's just some boring number on a spreadsheet somewhere, you are about to see exactly why that decision is already moving silver, already moving gold, and already reshaping where the smart money is flowing right now. Silver is sitting at $76 an ounce as we record this. Gold is above $3,200. And the East, China, India, the entire BRICS bloc, they didn't panic when this news dropped. They didn't scramble. They didn't sell. They smiled because they already knew. Let's go back to the moment this actually happened. Moody's released their statement, and the language was surgical. They said the United States federal debt is on a path to reach 134% of GDP by 2035. Right now, it's at 98%. The annual deficit is expected to hit nearly 9% of GDP. Interest payments alone on that debt are swallowing more money than the entire U.S. defense budget. Think about that for a second. America is now spending more money just paying interest on what it owes than it spends on its entire military. Moody's didn't do this to be dramatic. They did it because the math stopped working. This is the third time in history that a major agency has stripped America of its top rating. Standard & Poor's did it in 2011. Fitch did it in 2023. And now Moody's in 2026 has completed the sweep. Every single major credit rating agency on the planet has looked at the books of the United States government and said the same thing. We can't call this risk-free anymore. Now here is where it gets real for you as someone watching this channel. When a country loses its top credit rating, what happens to its currency? It weakens. What happens when the dollar weakens? Hard assets go up, gold goes up, silver goes up. This is not theory, this is a pattern that has repeated itself every single time in modern financial history. After the 2011 S&P downgrade, silver had already been running hot, but the psychological break that downgrade created added fuel to a fire that took silver to nearly $50 an ounce within months. People who were positioned before that announcement made life-changing returns. People who waited for the news to settle down missed the entire move. We are at that same moment right now, except this time, the downgrade isn't coming from one agency. It's confirmed by all three. And silver is at $76, not $49, not $32. $76 an ounce, already more than double where it was just a year ago. And the rating agencies are now officially telling the world what the East has known for 2 years. America's financial credibility has a crack in it. The question isn't whether this matters. The question is, are you going to act on it before the next move, or are you going to explain to yourself later why you saw it coming and did nothing? Let's talk about why silver specifically moves when America's credit gets cut. Most people think gold is the only safe haven. That's what Western financial media has told you for decades. Gold is the serious one. Gold is for central banks. Gold is for the big players. Silver is the little brother, the noisy one, the one that spikes and crashes and can't be trusted. That narrative is exactly why silver at $76 is one of the most significant prices in modern precious metals history. And most people in the West are still sleeping on it. Here's the connection that Wall Street doesn't explain cleanly. When the U.S. credit rating gets downgraded, 3 things happen simultaneously. The dollar loses prestige as the world's reserve anchor. U.S. Treasury bonds become slightly less attractive to foreign buyers. And institutional money starts quietly, not publicly, quietly, looking for assets that don't carry government counterparty risk. Gold absorbs some of that flow. It's already above $3,200 right now. But here's what most people miss. Silver absorbs the industrial demand on top of the monetary demand. You're not just getting the safe haven buyers. You're getting the manufacturers, the solar panel producers, the EV companies, the AI data center builders, all of them competing for the same limited supply of physical silver. Bank of America looked at this exact setup and published a target range of $135 to $309 for silver. They didn't put $309 in their report as a joke. That number represents what happens when you apply historical gold to silver ratio compression to current gold prices and add in the structural supply deficit that the Silver Institute has now confirmed for the 6th straight year running. 67 million ounces. That is the projected shortfall in silver supply for 2026. 67 million ounces more demanded than produced. Every year, the deficit compounds. Every year, the above-ground stockpiles shrink. And every year, the industrial dollars an ounce that is still, by almost every historical metric, dramatically undervalued relative to gold. The gold to silver ratio right now sits above 40 to 1. The historical average is closer to 47 to 1 across the last century, but during true bull markets, 2011 being the clearest modern example, that ratio compressed to 31 to 1. If gold stays anywhere near current levels and the ratio returns to 31, you're looking at silver well above $100. If gold continues climbing while silver plays catch-up, Buffett's $309 stops looking crazy and starts looking like math. JP Morgan has silver averaging $81 for all of 2026. That's their base case. Their base case. And here you are, watching this, with silver at $76 after a Moody's downgrade, just removed the last remaining ORE stamp from American sovereign debt. The West is sitting in denial. They're telling themselves this is a minor technical adjustment. They're saying the dollar is still the world's reserve currency. They're waiting for some analyst on CNBC to tell them it's safe to care about silver. The East stopped waiting for permission 2 years ago. While American investors were debating whether the Moody's downgrade was really a big deal, China had already moved. This isn't speculation. This is documented, publicly available data that almost nobody in Western financial media connects into a single coherent picture. China's silver imports have been running at record levels throughout 2026. The Shanghai Futures Exchange nearly found itself in a default situation earlier this year because its inventories had been so thoroughly drained, partly from bailing out the London Bullion Market Association, which itself came dangerously close to a default event in late 2025 after a massive physical silver buying surge driven by Indian Diwali demand caught Western vaults completely off guard. They tightened export licenses. They effectively said, "This metal is ours now, and you will not be pulling it out of our country easily." That single policy decision sent shockwaves through global silver supply chains that are still reverberating today. India is an even larger part of this story. India's physical silver demand dwarfs China's more than twice the volume in some estimates. Indian buyers have shown zero sensitivity to price. At $50, they bought. At $70, they bought. At $76, they are still buying. The cultural and generational connection to physical precious metals in the Indian subcontinent does not respond to Western market signals the way analysts in New York expect it to. And then there's the BRICS factor. For years, Western economists dismissed the idea that BRICS nations would meaningfully shift away from U.S. treasuries as a reserve asset. That dismissal is looking increasingly naive. Emerging market central banks have been quietly accumulating silver and gold alongside each other, treating silver not just as an industrial input, but as a monetary and strategic asset in its own right. When Moody's made their announcement, here's what Eastern financial desks did not do. They did not panic, sell their silver positions. They did not rush to convert back into dollars. They did not schedule emergency meetings about what the downgrade meant for their portfolios. They had already done their homework. The downgrade wasn't a surprise to anyone who had been watching America's debt trajectory of the story that silver investors need to understand right now. The Moody's downgrade is not the cause of what's happening in silver, it is the confirmation. The East has been positioning for this reality for 2 to 3 years. The physical silver they accumulated when it was at $30, at $40, at $50, that silver is sitting in vaults in Shanghai, in Mumbai, in Riyadh, and it is not coming back to the Western market at anywhere near those prices. What you're watching at $76 is not the beginning of a silver story. You're watching the West finally starting to catch up to a trade the East has been running for years. So where does this go from here? Let's be direct. Silver at $76 after the Moody's downgrade is not the peak of this story. Here's why. The Federal Reserve is now in an impossible position. Inflation is still sticky, growth is slowing. The U.S. government needs rates to come down because the interest burden on $34 trillion in debt becomes catastrophic if rates stay elevated for years. But if the Fed cuts rates aggressively, they risk reigniting inflation and further weakening the dollar at exactly the moment when its credibility is already under official scrutiny from every major ratings agency on Earth. Every single scenario in that matrix is bullish for silver. Rates stay high. Economy weakens, recession fears rise, safe haven demand for silver increases. Rates come down, dollar weakens, monetary metals rally. Silver gets the dual boost of both safe haven and industrial demand expansion. Stagflation scenario, dollar credibility erodes faster, hard assets become the only rational store of value, silver demand from emerging markets accelerates. There is no clean exit for the Fed that is simultaneously bad for silver. That is an extraordinary statement. And it is supported by the current price data, the supply deficit data, and the behavior of institutional buyers on both sides of the world. JP Morgan says $81 average for 2026. That's their conservative base case. UBS has a year-end target of $80. Bank of America's bull case, which requires only moderate gold-silver ratio compression from current levels, takes you to $135 and beyond. Their extreme scenario, which is not even their base case, gets you to $309. Now, nobody can tell you with certainty when those targets get hit. Markets don't move on schedules. Silver is notoriously volatile. It can drop $8 in a day and recover $12 in the next 3 days. That volatility is the cost of admission to an asset that has already doubled in a year and has structural tailwinds that are not going away. What the Moody's downgrade changes is the narrative permission structure in the West. Here's what that means. Millions of American investors have been sitting on the sidelines of the silver trade because there was no official stamp on the thesis, no mainstream anchor, no moment where a recognized institution said, in plain language, that the financial foundations are shifting. Moody's just gave them that moment. The last OR rating is gone. The full sweep of all three major agencies is now complete, and the institutional players who need that kind of official confirmation before they move, they now have their permission slip. That is fresh demand entering a market that already has a 67 million ounce annual deficit. That is Western institutional money starting to chase a trade that Eastern money has been running for 2 years. That is a setup that, historically, produces the most explosive moves in silver prices. You are watching history move in real time. Silver at $76 today. A Moody's downgrade that removes the last fiction of infinite American financial strength. An East that has been silently, methodically, aggressively accumulating the one metal that sits at the intersection of monetary value and industrial necessity. The West didn't believe it at $32. They didn't believe it at $50. They still don't fully believe it at $76. At some point, belief becomes irrelevant because the price will have already moved. Invest with logic, not hype. OG out. Right now, as you're watching this video, 4 of the biggest corporations on the planet are spending $715 billion. Not on real estate, not on oil, on something most Americans haven't even thought about yet. And that something is silver. Meta, Google, Microsoft, Amazon, $715 billion in AI infrastructure. Data centers the size of small cities, millions of processors, billions of circuit connections, and every single one of them requires silver to function. But here's what nobody is telling you. Silver is sitting at $75 an ounce right now, down 40% from its all-time high of $121 just 4 months ago. And the average Western investor? He has absolutely no idea what is quietly building beneath the surface. I'm OG, and today we are going to follow the money, all $715 billion of it, straight to silver. Stay with me, because by the end of this video, you will never look at your phone, your laptop, or your AI assistant the same way again. These trillion-dollar data centers uses silver in its electrical contacts, its circuit pathways, and its thermal management systems. Why silver? Because silver is the single best electrical conductor on Earth, better than copper, better than gold, and at industrial scale. There's no substitute that performs the same job at the same efficiency. Now here's where the numbers get uncomfortable. Meta alone has committed $65 billion in AI capital expenditure for 2026. Google, $75 billion. Microsoft, $80 billion. Amazon, $105 billion. That is $325 billion from 4 companies alone. Add NVIDIA's supply chain partners, the data center construction firms, the semiconductor manufacturers across East Asia, and the total AI infrastructure spend crosses $715 billion for this year alone. Every single dollar of that spend has silver embedded in it somewhere. Now, let me give you one number that should make you put your phone down and pay attention. The total global silver supply in 2026 is projected at 1.05 billion ounces. That sounds enormous until you understand that demand already exceeds supply. The Silver Institute projects a physical deficit again this year, and that forecast was built before $715 billion in AI spending became a confirmed structural demand driver. The Western financial media is talking about silver's crash from $121. They are calling it a bubble. They are saying the rally is finished, the story is dead, move on. But the procurement managers at chip factories in Taiwan, South Korea, and Japan, the people actually ordering the physical silver that builds the processors powering this AI revolution, they are placing orders right now, not speculating, ordering. And this right here is the disconnect that costs Western investors real money every single time. When silver hit $121 in January 2026, Wall Street panicked. The CME, the exchange that controls paper silver futures trading in the United States, raised margin requirements overnight. That forced leveraged traders to liquidate positions immediately. Price collapsed 40% in less than 48 hours. Western retail investors saw red numbers and ran. Eastern industrial buyers saw a clearance sale. While American traders were dumping silver ETFs, manufacturers across Asia were securing physical delivery contracts at $70, $72, $75 per ounce. They do not trade paper silver. They do not respond to margin calls. They buy the physical metal because their production lines require it. For chips, for electronics, for the AI infrastructure that Western corporations are paying them billions to build. This is not a theory. This is supply chain mechanics. As of this week, silver trades near $75 to $76 an ounce. Gold sits near $3,300. The gold to silver ratio, the figure that measures how many ounces of silver equal 1 ounce of gold, currently stands near 44 to 1. Historically, during precious metals bull markets, that ratio has compressed toward 30 to 1. If gold holds at $3,300 and that ratio moves to 30, silver crosses $110 an ounce. That is the conservative, historically grounded case. The AI demand variable we are discussing today is not yet in those traditional models. That is new. That is additional upside. The market has not priced. Let me show you exactly how this disconnect plays out in the real world. Because this is where most YouTube channels stop, and this is where the real story actually begins. There are two silver markets operating simultaneously right now, and they are moving in completely opposite directions. The first market is the one you see on your screen when you Google silver price. That number, $75, $76, $70, that is the paper silver market. COMEX futures contracts traded in New York. These are not physical bars sitting in a vault. These are promises, legal agreements to deliver silver at a future date, and the overwhelming majority of them are settled in cash, never in metal. This market is dominated by large financial institutions, hedge funds, and algorithmic traders who have never held a single silver coin in their lives. The second market is invisible to most Western investors. It operates in Shanghai, in Mumbai, in Tokyo, in Seoul. This is the physical market, where actual silver bars change hands, where delivery is not optional, where the metal moves from seller to buyer in the real world. And right now, this market is experiencing something that should alarm every paper silver trader in New York. Physical premiums are rising. When demand for real, deliverable silver exceeds supply, buyers pay above the spot price to secure metal. That premium, the gap between what paper silver trades for and what physical silver actually costs to buy, is widening. This is not a retail phenomenon. This is happening at the institutional and industrial procurement level. Chip manufacturers in Taiwan are not calling their broker to buy a futures contract. They are calling refiners and negotiating direct physical delivery agreements. And they are paying above spot to lock in supply. This is the signal that matters, not the paper price, the premium. Now let's bring in the macro layer, because silver does not trade in isolation. The Federal Reserve held interest rates steady at its April 2026 meeting. No cuts, no signal of imminent cuts. The official reasoning is that inflation remains persistent, partially driven by energy supply disruptions connected to the ongoing US-Iran standoff and the continued uncertainty around the Strait of Hormuz. For silver, this creates a complex picture that the mainstream media consistently oversimplifies. High interest rates are traditionally considered bearish for precious metals, and that is partially true for gold, which pays no yield and competes directly with interest-bearing assets. But silver's equation is fundamentally different because 60% of silver demand is industrial. It does not care about interest rates. A semiconductor manufacturer in South Korea does not decide whether to buy silver based on the federal funds rate. They buy it because their production line requires it. Period. This means that while Western financial media frames every Fed decision as automatically negative for silver, the industrial demand floor is completely immune to monetary policy. You cannot replace silver in a circuit board because Jerome Powell holds rates at 5%. And here is the number that Wall Street analysts are quietly acknowledging, but not broadcasting to retail investors. The Silver Institute's 26 World Silver Survey projects physical investment demand rising 20% this year to 227 million ounces. That is a 3-year high. At the same time, total global silver supply is expected to grow just 1.5%. Reaching 1.05 billion ounces. A structural deficit continues for the 4th consecutive year. 4 years of consecutive deficits. In any other commodity market, 4 consecutive years of supply deficits would generate front-page headlines and institutional panic buying. In silver, it generates a 40% price crash because a futures exchange in New York raises margin requirements overnight. Think about what that tells you about who controls the price, and how long that control can realistically be maintained when physical demand from AI infrastructure, from Eastern investment demand, and from a rising physical premium market is all pulling in the same direction. The paper market controls the price today. The physical market determines the price tomorrow. Let's talk about the number that every serious precious metals investor watches, but almost nobody in mainstream financial media explains properly to everyday people: the gold to silver ratio. Right now, gold trades near $3,300 per ounce. Silver trades near $75 per ounce. Divide those two numbers and you get a ratio of approximately 44 to 1. That means it takes 44 ounces of silver to buy 1 ounce of gold. Now, here's why that number is extraordinary, and why it represents either a massive opportunity or a serious warning, depending on which side of this trade you're sitting on. Historically, during the Roman Empire, the gold to silver ratio was fixed at 12 to 1. In the 20th century, the average ratio hovered between 40 and 50 to 1. During major precious metals bull markets, 1980, 2011, the ratio compressed dramatically. In 1980, it touched 17 to 1. In 2011, it fell to 32 to 1. Both of those compression events represented silver dramatically outperforming gold during the same bull cycle. We are currently in a precious metals bull market. Gold has confirmed that with its move toward $3,300, silver confirmed it with its January spike to $121. The question is not whether silver will eventually outperform gold in this cycle. Historically, it always has. The question is when. And the $715 billion AI demand variable may have just answered that question earlier than most analysts expected. Here is the institutional positioning that you need to understand, because this is where the story gets uncomfortable for anyone who dismissed silver as a retail investor toy. J.P. Morgan, the largest bank in the United States, projects silver averaging $81 per ounce for full year 2026. That is their base case, their conservative number, built on traditional industrial demand models that do not fully account for AI infrastructure acceleration. Bank of America is significantly more aggressive. Their head of metals research has maintained a bull case target of $309 per ounce for 2026. That projection is based on historical gold to silver ratio compression combined with the physical shortage thesis, specifically the argument that paper pricing mechanisms are systematically suppressing silver below its true market clearing price. Citi projects $150 per ounce as a bull case scenario. 3 major Wall Street institutions, 3 targets that all sit dramatically above the current $75 price. And yet silver is at $75, down 40% from its January high, because of what happened in the paper market during the last week of January 2026. This is the part of the silver story that the mainstream financial press covered for exactly 48 hours and then quietly moved on from, because the implications are deeply uncomfortable for the credibility of U.S. commodity markets. On January 29, 2026, silver touched $121.67 per ounce, an all-time record high. Within the same trading session, the CME Group, the exchange that operates COMEX and controls the rules of silver futures trading in the United States, announced an emergency increase in margin requirements. What does that mean in plain language? It means that overnight, anyone holding a leveraged long position in silver futures was required to immediately deposit significantly more cash to maintain that position. Traders who could not meet the margin call were automatically liquidated, forced to sell their contracts at any price available in the market. This created a cascade of forced selling that had nothing to do with silver's fundamental value, nothing to do with supply or demand, and everything to do with the mechanics of a derivatives market operating under rules set by a private exchange. Silver fell from $121 to under $80 in less than 48 hours. That move was not the market discovering silver was overvalued. That move was a margin mechanism forcing leveraged paper traders out of positions, while physical silver buyers in Asia treated the resulting price drop as a discount sale and accelerated their purchasing. The West saw a crash. The East saw a clearance event. That gap in perception, that fundamental difference in how Eastern and Western market participants interpret the same price movement, is the central thesis of everything we are discussing today. And it is precisely why the next phase of the silver story will not be driven by Wall Street sentiment. It will be driven by physical reality. So where does this all lead? Because understanding the past is only valuable if it helps you see what is building right now, beneath the surface, away from the headlines, in the places that Western financial media simply does not look. Let me give you 3 converging forces that are simultaneously pressing against silver's current $75 price, and explain why the window between what silver costs today and what it should cost based on physical reality may be closing faster than most analysts are publicly willing to admit. The first force is structural industrial demand acceleration. We have already established that $715 billion in AI infrastructure spending is embedding silver consumption into the global economy at a scale that has never existed before. But here is what makes this different from previous industrial demand cycles. Solar panels, electric vehicles, medical devices, these all consume silver, but they are discretionary at the macro level. Governments can slow green energy subsidies. Consumers can delay EV purchases. Nobody is delaying AI. The 4 largest technology companies on Earth have already committed their capital. The data centers are already under construction. The chips are already on order. This demand is locked in. It is not a forecast. It is a purchase order. And every purchase order for AI hardware contains silver that must be physically sourced, refined, and delivered. The second force is Eastern investment demand reaching a scale that Western markets have not yet priced. India, the world's largest consumer of physical silver by volume, imported a record quantity of silver in 2025. Chinese institutional buyers, following years of gold accumulation that drove gold toward $3,300 per ounce, are now rotating attention towards silver at what they consider historically discounted prices relative to gold. The gold to silver ratio at 44-1 is not invisible to Asian institutional investors. They can read the same historical charts that show that ratio compressing to 17-1 during previous bull markets. The Silver Institute projects physical investment demand rising 20% in 2026 to 227 million ounces. That figure is a 3-year high. And it is being driven not by American retail speculation, but by systematic, disciplined accumulation across Asian markets where physical ownership of precious metals is culturally normalized and institutionally encouraged. When Eastern buyers accumulate physical silver at this scale, they do not sell it back into the paper market at the first sign of volatility. It is removed from the available supply pool permanently. Every ounce that moves from a COMEX-registered vault into physical ownership in India, China, or Southeast Asia is an ounce that cannot be used to settle a future paper contract. This is how physical markets ultimately overwhelm paper pricing mechanisms, not in a single dramatic moment, but through the slow, relentless accumulation of physical metal by buyers who are not subject to margin calls, not managed by algorithmic trading systems, and not influenced by a CNBC segment. The third force is the supply ceiling. Global silver mine production is structurally constrained. The largest silver-producing nations, Mexico, Peru, China, Australia, are not opening significant new mines at the speed required to meet accelerating demand. Silver mine development takes between 7 and 15 years from discovery to production. The supply response to 2025's price surge cannot arrive in 2026. It cannot arrive in 2027. The market is operating on fixed supply against expanding demand, and a 4-year consecutive deficit is the mathematical result of that equation. Here's what all 3 of these forces add up to when you put them together: a physical market running consecutive deficits. Eastern accumulation removing metal from available supply. $7 to $15 billion in AI infrastructure locking in industrial consumption. And a paper pricing mechanism that temporarily suppressed the price 40% below its January high, giving every patient, informed buyer a second entry point that the January panic made look impossible. JP Morgan sees $81. Bank of America's bull case is $309. The gold to silver ratio at historical compression targets implies silver above $110 if gold simply holds where it is today. The West is looking at a price chart and seeing a crash. The East is looking at the same chart and seeing an opportunity. You now have the information to decide which side of that trade makes sense to you. I am OG. I do not tell you what to buy or when to buy it. I show you the data, the mechanics, and the institutional positioning that the mainstream financial media consistently leaves out of the conversation. Do your own research. Talk to a licensed financial advisor before making any investment decision. But whatever you decide, decide with logic, not hype. OG out. Right now, at this very moment, your bank is doing something to your money that they will never put in a press release. They will never announce it on CNBC. They will never send you an email about it. And if you ask your bank manager directly, they will smile and hand you a brochure about their premium savings account with a 4.5% annual yield. Here is what that smile is hiding. If your savings account is earning 4.5% interest right now, and inflation is running at 6.2% according to the latest Bureau of Labor Statistics data, then you are not earning money. You are losing it every single month, slowly, quietly, mathematically. Let's put real numbers to this because this is where it gets impossible to ignore. The average American household has approximately $62,000 in savings. At 4.5% annual interest, that account earns $2,779 in a year. Sounds reasonable. But at 6.2% inflation, the purchasing power of that $62,000 declines by $3,944 in the same year. You earned $2,190. You lost $3,244. Your net loss in real terms is over $1,000 on money you thought was safely sitting in the bank. That is not a savings account. That is a slow motion trap. And here is the number that should make every American stop scrolling right now. Silver is currently trading at $73 per ounce. In January 2026, just 4 months ago, silver was at $121 per ounce. That is a 40% decline driven by war headlines, Federal Reserve paralysis, and institutional paper selling on the COMEX in New York. But here is what nobody is telling you about that $73 price tag. Bank of America's precious metals analyst has a standing silver price target of $135 to $309 per ounce for 2026. That target was not pulled from thin air. It is based on supply deficit data, industrial demand projections, and the gold to silver ratio, which currently sits at 64 to 1. Historically, that ratio averages between 47 and 55. Every single time it has stretched to 64 or beyond in modern financial history, silver has corrected violently upward. Gold is sitting at approximately $4,700 per ounce right now. If the gold to silver ratio compresses to just 50 to 1, not a historic low, just a return to average, silver would need to trade at $94 per ounce. That is a 28% gain from today's price without gold moving a single dollar. Your savings account earning 4.5% needs 3 years to match that move. Silver could make it in months. Now, before anyone dismisses this as speculation, let's be very clear about something. We are not talking about predictions. We are talking about arithmetic, the math of what your savings account is actually doing to your purchasing power versus what silver has done historically during periods of monetary stress. The United States is in a period of monetary stress right now. The Federal Reserve has held interest rates at 3.5% to 3.75% for months. The Strait of Hormuz, the most critical oil shipping lane on the planet, has been blocked since late February, pushing oil toward $100 per barrel. Inflation is not cooling. It is being held in place by war, supply disruption, and a Federal Reserve that is trapped between cutting rates to stimulate growth and raising rates to fight prices. In this environment, stagflation, institutional uncertainty, and currency purchasing power erosion, there's a 5,000-year track record of one asset holding value when everything else wobbles. Silver is not a cryptocurrency. It is not a meme stock. It is not a speculative tech bet. It is an element on the periodic table with industrial applications in solar panels, electric vehicles, medical devices, and electronics. Applications that are growing, not shrinking. And it is trading at $73 per ounce while the math of your savings account is quietly working against you. The bank trap is not a conspiracy theory. It is a spreadsheet. Let's run a comparison that your bank's financial advisor will never voluntarily sit down and show you. Not because they are evil, but because their compensation structure depends on you not running this particular set of numbers. We are going to look at 3 scenarios over the past 5 years. A savings account, the S&P 500, and silver. In January 2021, the average high-yield savings account in the United States was earning approximately 0.5% annually. By 2024, that climbed to around 4.5% as the Fed raised rates. Average those out over 5 years. You are looking at roughly 2.5% average annual return on cash savings over this period. The S&P 500 has returned an average of approximately 15% annually over the same 5-year window. But that number includes a brutal 2022 where the index dropped over 19%, wiping out paper gains for millions of retail investors who sold at the bottom. Now, silver. In January 2020, silver was trading at approximately $18 per ounce. By January 2026, despite the recent 40% correction from the all-time high, silver was still trading around $73 per ounce at its recent crash lows. That is a 305% gain over 6 years, even at the bottom of its current correction cycle. Let that number land, 305%. While your savings account compounded at 2.5% per year, producing a total return of roughly 13% over the same window. Now let's bring in gold, because the comparison is equally revealing. Gold was trading at approximately 1,550 per ounce in January 2020. Today it sits at $4,700. That is a 203% gain in 6 years. No inflation, no erosion, no bank fee structures eating into your returns. Just the metal sitting there, doing exactly what it has done for 5,000 years of human civilization. The math is not complicated. The problem is that nobody presents it side by side with your savings account statement. Here is why that matters right now specifically. The United States M2 money supply, the broadest measure of dollars in circulation, expanded by approximately 40% between 2020 and 2022 due to pandemic-era stimulus spending. 40% more dollars chasing the same amount of goods and services. That is the root cause of the inflation that has not fully gone away. And it is the root cause of the purchasing power erosion that your savings account cannot outrun. Silver and gold are not affected by money printing. You cannot create more silver by running a printing press. The Silver Institute projects that global silver mine supply will grow by less than 2% annually through 2030, while industrial demand from solar panels alone is projected to grow by double digits every year through the same period. Supply constrained, demand expanding. Price currently suppressed by paper selling on a futures exchange in New York. This is the setup that preceded every major silver rally in modern financial history. In 2010 and 2011, silver ran from $18 to $49 in approximately 14 months, a 172% gain, driven by exactly this combination: dollar weakness, inflation fears, and physical demand overwhelming paper market suppression. The catalyst that broke the paper price was simply physical buyers refusing to sell at artificially low prices. China and India are currently playing that exact role. China imported 836 tons of silver in a single confirmed surge. India remonetized silver on April 1st of this year. Two nations representing nearly 3 billion people are treating $73 silver the way smart money treated $18 silver in 2010. Your savings account earned 4.5% last year. It will earn approximately 4.5% this year. And if inflation stays above that rate, which every major economic forecaster currently projects, your purchasing power will continue to decline. The bank trap is not loud. It does not slam shut dramatically. It closes so slowly and so quietly that most people never notice until they try to retire on savings that cannot buy what they expected. Here's something that almost nobody in the mainstream financial media ever discusses when they talk about silver, and it is the single most important factor separating silver from every other precious metal on the planet right now. Silver is irreplaceable in the industries that are growing fastest in the global economy. Gold is beautiful. Gold is monetary. Gold is the ultimate store of value. But gold's industrial demand accounts for only about 10% of total annual consumption. The rest is jewelry, investment, and central bank reserves. Silver is different. Approximately 60% of total annual silver demand comes from industrial applications, and those applications are not in declining industries. They are in the industries that every government on Earth is currently subsidizing, mandating, and building at breakneck speed. Solar panels. Every single photovoltaic cell, the component in a solar panel that converts sunlight into electricity, requires silver paste as a conductor. There is no substitute that works as efficiently at scale. Every gigawatt of solar capacity installed globally requires approximately-driven medical silver demand to record levels. 5G infrastructure. Every 5G antenna array contains silver components. The global 5G build-out, which is approximately 30% complete worldwide, will require an estimated 75 to 100 metric tons of silver through 2030. Now, here is where this gets critical for the price equation. The Silver Institute's most recent World Silver Survey projects a supply deficit of approximately 215 million ounces in 2026. That means demand exceeds mine supply by 215 million ounces. That gap is being filled by above-ground inventory, stockpiles that are finite and declining. When above-ground inventory runs low enough that industrial buyers cannot source physical silver at the COMEX paper price, one of two things happens. Either industrial production slows, which no solar panel manufacturer or EV company is going to allow voluntarily, or the price corrects violently upward to attract new supply. There's no third option. A solar company building a gigawatt-scale panel factory does not have the option of using less silver. A hospital cannot substitute a cheaper metal in its surgical equipment. An EV manufacturer cannot redesign its battery management system because silver got expensive. These buyers will pay whatever price the market requires because their entire business model depends on having the metal. This is fundamentally different from investment demand, which is price sensitive. Industrial demand is price inelastic, meaning buyers will pay up rather than go without. At $73 per ounce, with a projected 215 million ounce supply deficit, the silver market is sitting on a structural imbalance that paper futures trading in New York is temporarily masking. The mask comes off when physical inventory runs low enough that industrial buyers start competing aggressively for available supply. Your savings account has no equivalent catalyst. It will earn whatever the Federal Reserve allows banks to pay, currently somewhere between inflation and zero in real terms. Silver's price is being set by two forces simultaneously: a paper market in New York responding to macro fear, and a physical market globally responding to industrial necessity. When those two forces collide, and the supply deficit data says that collision is coming, one of them will win decisively. Industrial necessity has always won that fight historically. Always. We have spent this entire video building a case from data. Not opinion, not prediction. Data. So let's close with the most important data exercise of all, the personal financial comparison that your bank will never run for you. Take $10,000, a round number, the kind of money that millions of Americans have, sitting in a high-yield savings account right now, earning 4.5% annually and feeling responsible about it. Scenario A, the savings account. $10,000 at 4.5% annually for 3 years, 11,412. Adjusted for 6.2% inflation over the same 3 years, or a real purchasing power of approximately $9,546 in today's dollars. You saved, you earned interest, you lost purchasing power. Net result, you're poorer in real terms than when you started. Scenario B, silver at $73. $10,000 buys approximately 136 ounces of silver at today's price. If silver reaches Bank of America's conservative target of $130, not the 309 upper target, just $135, those 136 ounces are worth $18,360. That is an 83% gain in the same 3-year window where your savings account lost purchasing power. Scenario C, the middle ground, if silver simply returns to its January 2026 all-time high of $121 per ounce, no new record, just a recovery to where it was 4 months ago, your 136 ounces are worth $16,156. That is a 64% gain. 3 scenarios, 3 completely different outcomes. One of them involves trusting your bank to protect your purchasing power. 2 of them involve understanding what silver is doing at $73 per ounce and why. Now, important context. This is not financial advice. Nobody can guarantee that silver hits $135 or returns to $121. Markets are unpredictable, and silver is volatile. The 40% decline we just witnessed proves that silver can move sharply in both directions. Past performance does not guarantee future results. What we can say with certainty is this: the structural case for silver, the supply deficit, the industrial demand growth, the gold to silver ratio at 64-1, the Eastern accumulation, the currency debasement is stronger today than it was when silver was trading at $18 in 2020. The bank trap is not about your bank being malicious. It is about a system that was designed in an era of stable inflation and sound monetary policy. And that system has not been updated to reflect a world where the Federal Reserve printed 40% more dollars in 2 years, where a war is blocking the world's most important oil shipping lane, and where the 2 largest nations on earth are quietly moving their wealth into hard assets. Gold at $4,700 is telling you something. China importing 836 tons of silver is telling you something. India remonetizing silver is telling you something. Bank of America targeting $135 to $309 is telling you something. Your savings account is also telling you something. It is telling you that it will earn 4.5% while inflation runs at 6.2%, and that the difference between those 2 numbers is the price you pay for trusting the system without questioning it. The math is not complicated. The math is just uncomfortable. And uncomfortable math, the kind that actually changes how you think about your money, is exactly what this channel exists to put in front of you. This is OG, invest with logic, not hype. OG out. Right now, as you watch this video, solar panels are eating silver, not borrowing it, not using a little bit of it, devouring it. And the price you see today, $86 per ounce, is not a spike. It is not a rumor. It is the result of a supply war that started years ago, and most Americans have absolutely no idea it is happening. Let me give you a number that should stop you cold. In 2014, the solar industry consumed 11% of global silver industrial demand. That was 10 years ago. Today, in 2026, that number has exploded to 29%. Nearly 1/3 of all silver used in industry is being consumed by solar panels alone. And we are not slowing down. We are accelerating. Here is what nobody on mainstream financial television is telling you. Silver is not just a precious metal you buy when you are nervous about the stock market. Silver is the most electrically conductive element on the periodic table. Nothing else comes close. And modern solar panels, specifically the new generation called TOPCon and heterojunction cells, require silver on both the front and the rear of each panel. That is, double the silver per panel compared to older technology. Double. While the world is installing solar at a pace never seen before in human history, global solar installations now exceed 600 gigawatts annually. Each megawatt of solar capacity requires between 2,000 and 3,000 ounces of silver. Do that math. That is 1.2 billion to 1.8 billion ounces of silver demand from solar alone, every single year. And total global silver mine production in 2025 was just over 1 billion ounces. The math does not work. The supply is already broken. But here is where it gets even more alarming. Silver mining cannot simply ramp up overnight. Most silver in the world, over 70%, is not mined directly. It is a byproduct of mining copper, zinc, and lead. That means when the world needs more silver, miners cannot just open a silver mine and solve the problem. They have to mine other metals first and hope silver comes along for the ride. New primary silver mines take over a decade to build, permit, and operate. We do not have a decade. The deficit is happening right now. The global silver market has been running a deficit for 6 consecutive years, In 2025 alone, the shortfall was 230 million ounces. 230 million ounces short. And the accumulated deficit from 2021 through 2025 is estimated at 900 million ounces. That is nearly an entire year of global mine production. Gone. Absorbed. Consumed by industry faster than the earth can produce it. And yet the average American investor is still treating silver like a hobby metal, something you buy a few coins of and put in a drawer. While industrial giants, now let us talk about the East, because this is where the story gets uncomfortable for Western investors. China figured this out before anyone else, and in January 2026, China made a move that barely made headlines in the United States, but sent shockwaves through every serious commodities trading desk in the world. China implemented a new licensing regime for silver exports. Under the new rules, only companies with a minimum output of 80 tons per year and a $30 million credit line are eligible to export silver. That restriction eliminated most smaller producers from the export market instantly. The result, only 44 Chinese companies can now legally export silver to the rest of the world. Let that sink in. 44 companies. And according to Peel Hunt, the British investment bank, between 60% and 70% of global refined silver supplies could be affected by this policy. China is not selling its silver to America. China is keeping its silver for itself, for its solar panels, its electric vehicles, its AI data centers, and its electronics manufacturing base. China looked at the supply math, understood what was coming, and quietly locked the door. Meanwhile, India moved even faster on the buying side. In 2025, India became the world's largest importer of refined silver, spending $9.2 billion on silver imports, a 44% increase over 2024. And that happened even as prices nearly tripled in rupee terms. Indian consumers and industry did not stop buying when prices went up. They accelerated. Silver in India crossed 3 lakh rupees per kilogram. And demand kept climbing. India is not buying silver because it is cheap. India is buying silver because it understands what silver is about to become. Now look at the United States. What is happening on the American side of this trade? The COMEX, which is the primary silver futures exchange in the U.S., has been experiencing something extraordinary. U.S. tariff uncertainty in early 2026 triggered a massive physical silver pull from London to American shores. London is the world's primary silver trading hub. As American institutions rushed to secure physical silver ahead of potential tariff changes, London silver stockpiles dropped to dangerously low levels. Warehouses linked to the Shanghai Futures Exchange also hit their lowest inventory levels in nearly a decade, with large volumes being shipped to London just to ease the squeeze. This is not normal commodities trading. This is a global scramble for physical silver. Institutions that spent years trading silver as a paper asset, futures contracts, ETFs, derivatives, are now demanding the real thing. Actual silver bars, actual physical metal. And the supply pipeline is not built to handle that kind of sudden physical demand. J.P. Morgan raised its silver price forecast significantly. Peel Hunt raised its first quarter 2026 silver price estimate by 67%, landing at $75 per ounce. And we have already surpassed that. Inflation-adjusted price targets from multiple institutional models range from $150 to $250 per ounce, depending on methodology. We are at $86 today. If even a fraction of those targets materialize, the investors who acted early are going to look like geniuses. The ones who waited are going to look at their savings accounts and wonder what happened. The Silver Institute, working with Oxford Economics, published a report calling silver the next generation metal. Not a relic, not a hedge, a next generation industrial material essential to solar, EVs, AI infrastructure, and the digital transformation of the global economy. When Oxford Economics uses language like that, institutional money moves, and it is already moving. Let us get into the technology side of this, because this is where most financial commentators completely miss the story. The solar industry is currently going through a technological revolution. The old standard solar cell technology was called PERC, passivated emitter and rear cell. PERC panels use silver only on the front side of the cell. The newer, more efficient technology is called TOPCon, tunnel oxide passivated contact. TOPCon cells require silver metallization on both the front and the rear side. That means every upgrade the solar industry makes to improve panel efficiency automatically increases silver demand per panel. And then there is HJT, heterojunction technology, which is even more advanced and uses up to 23 milligrams of silver per watt of output. The solar industry is chasing efficiency. More efficiency means more silver. It is a one-way ratchet, and it is tightening. Now, the solar industry knows it has a silver problem. They are not blind to this. Chinese manufacturers like LONGi Green Energy and Jinko Solar have been working to replace silver with copper in certain panel designs. LONGi announced plans to move to copper-based back contact cells with mass production expected in the second quarter of 2026. But here is the critical detail most people miss. Copper substitution only works for certain types of panels. TOPCon cells, which are the current efficiency leaders, are not easily compatible with copper due to high temperature fabrication requirements. Silver remains essential for high efficiency solar designs, even as manufacturers try to reduce usage. This means the substitution story is real but limited. China's manufacturers can reduce silver content per panel at the low efficiency end. But the high performance panels that governments and utilities actually want for large scale solar farms, those still need silver. And the scale of global deployment means that even with reduced silver per panel, total silver consumption from solar remains structurally high. By 2030, according to peer-reviewed research published in academic journals, total silver demand could reach between 48,000 and 54,000 tons per year. Global silver supply may only cover 62% to 70% of that need. In other words, the world could be running a structural silver deficit of 30% to 38% by the end of this decade. The solar industry alone could consume between 10,000 and 14,000 tons per year, representing up to 41% of total global silver supply just for solar panels. There is another demand wave coming that most investors have not even started to price in. Data centers and artificial intelligence infrastructure. The Silver Institute specifically highlighted strong structural growth in data centers, AI hardware, and the automotive sector as key silver demand drivers through 2030. Silver's electrical conductivity makes it irreplaceable in semiconductors, power electronics, and high-frequency computing hardware. Every AI server farm being built right now contains silver. Every electric vehicle rolling off a production line contains between 25 and 50 grams of silver, significantly more than a traditional gasoline-powered car. And global EV production is scaling at a rate that would have seemed impossible 5 years ago. The automotive industry alone is projected to account for 59% of silver demand share by 2031. Add solar, add AI data centers, add consumer electronics, add power grid upgrades. Now look at a mine supply that cannot grow fast enough, or grades that are falling as older mines produce less silver from the same amount of rock, and recycling rates that are too low to close the gap because silver used in electronics and solar panels is extremely difficult to recover at scale. This is not a forecast. This is arithmetic. So what does this mean for you? Sitting in America, watching silver hit $86, wondering whether you missed the trade? Here is the reality. Western investors are just now waking up. Global physical silver investment is forecast to increase approximately 20% in 2026, reaching 227 million ounces, a 3-year high. Western investors are returning after several years of weak demand, pulled back in by strong prices and growing economic uncertainty. That is new money entering the market, new demand being layered on top of an already deficit-stressed supply chain. The gold to silver ratio tells you something important. At its worst point this year, around what traders called Liberation Day, that ratio hit 105. That means it took 105 ounces of silver to buy 1 ounce of gold. Historically, that ratio averages between 50 and 70. A ratio of 105 means silver was historically cheap relative to gold at that moment. Today, that ratio has dropped back to 70 as institutional investors return to silver. But historically, in precious metals, bull markets, the ratio compresses hard. Silver outperforms gold dramatically during monetary easing cycles. And right now, the Federal Reserve is moving toward rate cuts, the US dollar is softening, and geopolitical uncertainty is pushing safe haven demand higher across the board. ING Bank, one of Europe's largest financial institutions, stated directly that silver should benefit from the same macro drivers expected to support gold. A softer dollar, Federal Reserve rate cuts, and renewed appetite for safe haven assets. But silver has an additional layer that gold does not have: industrial demand. Gold sits in vaults, silver goes into solar panels, EV batteries, AI servers, and smartphones. Silver gets consumed, it gets used up, it does not come back easily. The supply numbers confirm this structural reality. Peel Hunt raised its long-run silver price estimate from $30 per ounce to $50 per ounce. Their 2026 full-year forecast is $75 per ounce. We are already at $86. Multiple institutional models show inflation-adjusted silver targets between $150 and $250. Silver in India already crossed the equivalent of $94 per ounce in global terms earlier in 2026 before pulling back. The direction of this trade is not a mystery. The timing is the only question. Here's what separates investors who build wealth from investors who watch wealth being built by others. The ones who build it do not wait for the mainstream media to tell them the story is real. By the time CNBC runs a silver special, by the time your neighbor starts talking about it at a barbecue, by the time the trade is obvious to everyone, the easy money has already been made, East already moved, China locked its exports, India bought $9.2 billion worth. Institutions are pulling physical bars off London shelves. The comics squeeze is documented. The 6-year supply deficit is documented. The 230 million ounce shortfall in 2025 alone is documented. The question is not whether solar is eating silver. It is. The question is not whether the East planned this. They did. The question is what you're going to do with this information right now, today, while silver is at $86 and the structural deficit is widening every single quarter. Invest with logic, not hype. OG out. China just shut the door. And if you're holding dollars right now, you need to hear this. Let me show you exactly what happened. China's largest pure play silver fund, the kind of fund that lets everyday investors buy into physical silver, just stopped accepting new investors. Not because it failed, not because silver crashed, but because demand got so intense, so fast, that the fund managers got scared of their own success. Think about that for a second. A fund had to turn people away because too many people wanted silver. Meanwhile, in America, your financial advisor is still telling you to buy the S&P 500. Silver right now is sitting at $65 an ounce. That's not a typo. $65? 1 year ago, it was trading under $30. That's a 116% move in 12 months. And the people who saw this coming, they weren't on Wall Street. They were in Beijing, in Shanghai, in Mumbai. Here's what nobody's telling you on CNBC. The silver market in 2026 is in a structural deficit. That means the world is consuming more silver than it is producing, every single year. And that gap is getting wider, not smaller. The Silver Institute confirmed it. Global silver demand hit a record in 2025, driven by solar panels, electric vehicles, AI data centers, and military-grade electronics. Every single one of those industries runs on silver, and none of them have a substitute. But here's the part that should make you put down your coffee. China didn't just close that fund because of retail investor demand. China placed export controls on silver back in late 2024. They saw the supply squeeze coming before the rest of the world even opened their eyes. They locked their silver in, they stopped selling it out, and now their own citizens are rushing to buy what's left, so fast that fund managers had to shut the gates. This is not speculation. This is not a conspiracy theory. This is documented. This is on record. And this is happening right now while American investors are debating whether to put money into a tech stock that doesn't even turn a profit. Let me give you a number that will reframe everything you think you know about this market. JP Morgan, the largest bank in the United States, is sitting on one of the largest silver positions ever recorded. They're not selling, they're holding. Why would the smartest money on Wall Street hold silver while telling retail investors to stay away from it? Because the story they tell you on TV and the moves they make with their own money are two completely different things. Now, I want to be fair here. Some analysts will say, okay, silver had a good run, but $65 is overextended. Maybe it pulls back. And you know what? Short term, maybe they're right. Markets don't move in a straight line. But here's what those analysts are not accounting for. The deficit, the export controls, the AI boom swallowing silver by the ton, the fact that central banks across Asia bought a record $37 billion in precious metals just in Q1 of 2026 alone. These are not short-term headlines. These are decade-long structural shifts. And China closing that silver fund, that's not a blip. That's a signal. When a country that controls the largest manufacturing base on the planet starts locking down its own silver supply, and its own citizens start rushing to buy before the door closes completely, you have to ask yourself one question. What do they know that you don't? Stay with me, because what I'm about to show you goes much deeper than a fund closure. Let's talk about the number that Wall Street doesn't want trending on social media. $65 silver is not the ceiling. It might not even be the halfway point. Here's why. The gold to silver ratio, the number that tells you how many ounces of silver it takes to buy 1 ounce of gold, is still sitting around 80 to 1. Gold right now is trading above $5,000 an ounce. Do the math. At the historical average ratio of 50 to 1, silver should be trading at over $100 an ounce right now. At the 1980 peak ratio, we're talking $166 silver. That's not a prediction. That's arithmetic. But let's set the ratio aside for a moment. Because the real story isn't just about price. It's about who is moving first and who is going to be left scrambling. Go back to December 2024. China announced export controls on silver. Most Americans didn't even see the headline. It got buried under stock market news and political drama. But in Asia, in the trading rooms of Shanghai, in the government ministries of Beijing, everyone understood exactly what that move meant. China was drawing a line. They were saying, our silver stays here. You want it? Come find it somewhere else. And the world tried. London vaults started draining. COMEX silver inventories, the warehouses in New York that backed the paper silver market, began showing stress. Delivery notices spiked. The gap between paper silver and physical silver started widening in ways that professional traders hadn't seen in years. This is the part of the story that general financial media completely ignores. Because if they explained it clearly, too many people would start asking uncomfortable questions about the entire paper commodity system. Here's the uncomfortable truth. For every 1 ounce of physical silver that exists in a registered vault, there are estimates suggesting anywhere from 100 to 300 paper contracts written against it. That means if even a small percentage of silver investors demanded physical delivery at the same time, the system would break. China knows this. That's why they move first. Now here's where it connects to the fund closure that we talked about earlier. When China's pure play silver fund shut its doors to new investors, the official reason was risk management. Too much premium buildup over the underlying asset value. Fund getting too large too fast, standard financial language. Very calm, very professional, but read between the lines. The fund was getting too big because Chinese retail investors, hundreds of millions of ordinary people who watched gold and silver climb for 2 straight years, finally decided to get in. And when that many people try to get into a market that is already in a physical supply deficit, you don't get an orderly rally. You get a scramble. The fund managers saw that scramble coming and closed the gate before it turned into a stampede. Now ask yourself, if this is happening in China, what happens when American retail investors finally wake up? Right now, the United States retail investor is largely absent from the physical silver market. Yes, there are buyers. Silver Eagle coins sell well. Some ETFs have seen inflows. But compared to the scale of money sitting in stocks, bonds, and savings accounts earning real negative returns after inflation, the silver market is tiny. The moment even 1% of that American capital decides to rotate into silver, the physical supply cannot absorb it, not at these production levels, not with China keeping its silver at home, not with solar and EV manufacturers already locking up future supply through long-term contracts. This isn't a maybe, this is supply and demand, the most basic force in any market, and the clock is running. Because while Americans are waiting for permission from their financial advisor, the East already moved. Let me show you exactly how deep this rabbit hole goes. Because this isn't just about China. This is about a coordinated shift happening across the entire Eastern Hemisphere. And it's moving faster than any Western financial institution wants to admit. India imported a record amount of silver in 2025. We're talking about numbers that broke every previous record going back decades. Indian households, the same families that have stored physical gold and silver for generations, accelerated their buying as prices rose, not because they were chasing momentum, because in their culture, in their history, physical metal is the ultimate store of value. Paper promises have failed them before. Metal never did. Russia quietly increased its precious metals reserves. Iran, despite sanctions, despite economic pressure, continued accumulating. The Middle East sovereign wealth funds, the ones sitting on oil money looking for a home, started diversifying into hard assets at a pace that went largely unreported in American financial media. And then there's the industrial demand side of this equation. Because silver isn't just a monetary metal anymore. It hasn't been for a long time. Right now, the solar energy industry alone is consuming silver at a rate that analysts describe as extraordinary. Every single solar panel requires silver. There is no cheaper substitute that performs at the same efficiency level. And the world, driven by climate commitments, driven by energy independence goals, driven by pure economics, is building solar at a pace never seen before. China is building more solar capacity than the rest of the world combined. The European Union has mandatory green energy targets that require massive solar build-out. The United States Inflation Reduction Act is pumping hundreds of billions into clean energy infrastructure. Every single panel in every single one of those projects needs silver. And that's before we even get to electric vehicles. Every EV requires roughly twice the silver of a traditional combustion engine vehicle. Global EV sales hit record numbers in 2025, and the trajectory is only going up. And AI. Let's talk about AI for a moment. The data centers powering the artificial intelligence revolution, the ones being built right now across America, across Asia, across Europe, they run on silver-dependent components, high-performance computing chips, advanced circuit boards, next-generation cooling systems. Silver isn't all of it. We covered the AI silver drain in a previous video. $715 billion worth of AI infrastructure investment, all of it consuming silver. And that number is going up, not down. So let's stack this up clearly. You have Chinese export controls reducing global supply. You have Indian and Asian retail demand at record levels. You have central banks across the Eastern Hemisphere buying hard assets aggressively. You have solar, EV, and AI industries competing for the same physical silver that investors want. You have a paper silver market that is massively over-leveraged against physical supply. And you have American retail investors who are almost entirely on the sidelines. That combination, in any rational market analysis, points in one direction. But here's the part that makes this story genuinely alarming, rather than just bullish. The speed at which this could move. Silver is a small market. The entire global silver market is a fraction of the size of the gold market, which itself is tiny compared to stocks or bonds. When big money moves into a small market, prices don't drift up gradually. They spike. They move violently. They leave late buyers holding the bag. We saw a preview of this in early 2021 when retail investors tried to squeeze the silver market. Prices jumped nearly 20% in days before getting pushed back down. That was disorganized retail money with no staying power. What's happening now is different. This is sovereign money. This is institutional money. This is patient, strategic, long-term accumulation by people who think in decades, not in quarterly earnings cycles. And the door? It's closing faster than most people realize. So where does this leave you? Now, let's be honest about something. Most people watching this video already have a feeling that something is wrong, not just with silver, with the whole system. You see inflation eating your savings. You see your dollar buying less every single year. You see the government printing money and calling it policy. You see banks getting bailed out while ordinary people get squeezed. That feeling isn't paranoia. That feeling is pattern recognition. And silver, physical silver, is one of the oldest responses to that pattern in human history. But let me be clear about something important. I'm not here to tell you to panic. I'm not here to tell you to liquidate your retirement account and fill your basement with silver bars. That is not what smart investing looks like. What smart investing looks like is understanding what is happening before the crowd figures it out. Right now, the crowd hasn't figured it out. The mainstream financial media is still treating silver as a fringe asset. Your 401k advisor probably hasn't mentioned it once this year. Your bank certainly isn't promoting it, because none of those institutions make money when you buy physical silver and hold it yourself. But the institutions themselves, JP Morgan holds massive silver positions. Central banks across Asia are loading up on precious metals at a record pace. China locked down its own silver supply before the price explosion. These are not the actions of people who think silver is irrelevant. These are the actions of people who know exactly what is coming. Now let's talk about price targets, because I know that's what many of you came here for. Goldman Sachs has revised its silver outlook upward multiple times this year. Bank of America. Precious metals analysts have published research suggesting silver could reach $80 to $90 in 2026 under current supply deficit conditions. Some independent analysts who called the move from $25 to $65 correctly are now looking at $100 silver within 18 months. Are those targets guaranteed? Absolutely not. No price target ever is. Markets are messy. Corrections happen. Sentiment shifts. And anyone who tells you silver only goes up is either lying to you or selling you something. But here's what I know with confidence. The fundamentals driving silver higher, the supply deficit, the industrial demand, the Eastern accumulation, the monetary distrust, the paper market vulnerability, none of those fundamentals have reversed. Not one of them. And China closing its silver fund didn't reverse them either. If anything, it confirmed them. When a market gets so tight that fund managers have to turn away investors to prevent a price explosion, that is not a sign of a bubble. That is a sign of genuine scarcity, meaning genuine demand. Bubbles form when price rises have no fundamental backing. When tulips go up, because everyone expects tulips to go up, silver in 2026 is the opposite. Every time you charge your phone, drive an electric vehicle, use a solar panel, or interact with an AI system, silver made that possible. This metal is not going away. The demand is not slowing down, and the supply is not keeping up. So, while America waits for permission, and while the mainstream media catches up, while your financial advisor finally adds silver to his recommendation list 6 months too late, the East already moved. The door is already closing, and the ones who understood this story early will look back at $65 silver the same way early Bitcoin buyers look back at a $1,000 Bitcoin. Not as the peak, as the beginning. This is OG, invest with logic, not hype. OG out. While you were sleeping, two of the world's most populated nations were quietly doing something that Wall Street doesn't want you to notice. And here's the kicker. They're doing it right now, in the middle of a war zone crisis, while American investors are panicking and dumping silver at a loss. My name is OG, and today we are going to talk about something that should be on every American investor's radar, but isn't, because the mainstream media is too busy covering the Strait of Hormuz drama to tell you what's actually happening behind the scenes. So let's start with the facts. Silver right now is sitting at approximately $75 an ounce. That might sound decent, and it is, until you realize that just 4 months ago, in January 2026, silver touched an all-time high of 121.64 per ounce. That's a 34% drop in under 4 months. And most American retail investors, they panicked. They sold. They walked away. But China and India did not walk away. Here's what you need to understand about the current market. The Strait of Hormuz crisis, now entering its 10th week, has pushed energy prices through the roof and sent inflation fears to levels we haven't seen in years. Silver fell nearly 20% just from this conflict alone. When inflation fears go up, interest rate fears go up. When rate fears go up, paper assets get hammered. And when paper assets get hammered, average American investors dump their precious metals positions because they're scared. That is exactly what China and India are counting on. Let me give you a number that will wake you up. In 22-25, the global silver market ran a supply deficit of somewhere between 160 and 200 million ounces. That means demand was greater than supply, not by a little, but by almost 200 million ounces. And that deficit is continuing into 2026. Mine supply simply cannot keep up with the structural industrial demand that has been building for years. Now, why does this matter to China and India specifically? Because both of these nations understand something the average American investor does not. Silver is no longer just a shiny metal you stack in a vault. Silver is the backbone of the green energy revolution. It is inside every solar panel on Earth. It is inside every electric vehicle rolling off Chinese and Indian production lines. It is inside the AI hardware infrastructure that is being built at a pace we have never seen before in human history. China installed more solar capacity in 2025 than the entire rest of the world combined. And every single one of those solar panels required silver. India's solar mission is scaling at a rate that will require hundreds of millions of ounces of silver over the next decade alone. So when silver dropped 20% because of Hormuz panic, what did these two countries do? They bought more. Let me put this in a perspective that makes sense for you as an American investor. Imagine your neighbor is selling his house at a 34% discount because he's scared of the news. The neighborhood is about to boom. A major tech company is moving in next door. Property values are going to triple in 5 years. Do you walk away or do you buy? That is exactly what China and India are doing with silver right now. They are not reacting to headlines. They are positioned for a future that most Western investors cannot yet see, because the Western financial media is not telling them the full story. And that is what this channel exists to do, to tell you what they won't. Because here's the truth. Silver gained 148% in 2025 alone. It went from under $29 an ounce to over $70. That is not a fluke. That is a structural shift in global demand. And the nations that understand this are accumulating right now at discounted prices, while American investors panic sell into the chaos. Stay with me, because what happens next in this story is what will determine whether you are on the right side of this trade or the wrong one. Let's talk about gold for a moment, because you cannot understand what's happening with silver without understanding gold first. As of this week, gold is sitting at approximately $4,192 per ounce. Think about that number for a second. Gold has gone from around $3,241 a year ago to $4,490 today. That is a $1,951 gain per ounce in 12 months. The safe haven trade is alive and screaming. Now look at the gold to silver ratio. Right now, it takes approximately 61 ounces of silver to buy 1 ounce of gold. Historically, that ratio has averaged closer to 40 to 1 or even 30 to 1 during silver bull markets. What does that tell you? It tells you that silver is massively underpriced relative to gold, even after its 148% run in 2025. If silver were to simply return to a 40 to 1 ratio with gold at today's price of $4,592, that puts silver at $114 an ounce. If it returns to a 30 to 1 ratio, we are looking at $153 per ounce. That is not a wild prediction from a fringe newsletter. That is basic math using current market data. And China and India are doing this math every single day. Now let me show you why the Strait of Hormuz angle makes this even more critical for silver specifically. And this is the part that almost no American financial channel is connecting for their audience. The Strait of Hormuz is the single most important shipping choke point on the planet. Approximately 20% of global oil flows through it. When Trump announced a plan to escort civilian ships through the strait, Iran responded by warning that any U.S. military presence in those waters would be treated as a hostile act. A tanker was struck by projectiles shortly after that announcement. Here's how this connects to silver. Energy disruption means inflation. Inflation means central banks face a nightmare scenario. Do you raise rates to fight inflation and risk crashing the economy? Or do you hold rates and let inflation run? Either way, real assets win. Physical silver wins. This is not theory. This is exactly what happened during the 2020 global disruption, when silver surged approximately 47% in a matter of months. And the 2025 run from $29 to over $70 showed the exact same sensitivity to macro and geopolitical shocks. But here is where China and India play a completely different game than Western investors. Western investors buy silver when they're scared, then sell it when the fear passes. It's a panic trade. It's emotional. They treat silver like a thermometer for anxiety. Eastern nations treat silver like infrastructure. China's government has been quietly directing state-owned enterprises to secure physical silver and other industrial metals as part of its long-term strategic reserves. India's retail demand for physical silver, bars, coins, and jewelry hit record levels in 2025. Indian households alone are estimated to hold one of the largest private stockpiles of silver on Earth. And this is not new behavior. This is centuries of cultural and economic wisdom that views physical precious metals as real wealth, not as a trading vehicle to flip for a quick profit. Now let's talk about the supply side of this equation, because the demand story only gets more powerful when you understand how constrained supply really is. The top silver-producing nations on the planet are Mexico, Peru, China, Australia, and Chile. Mexico and Peru together account for a massive portion of global mine output. And here's the problem. New silver mining projects take anywhere from 8 to 15 years from discovery to full production. You cannot simply turn on a tap and produce more silver because the price went up. What this means is that the supply deficit we saw in 2025, that 160 to 200 million ounce gap, is not going away in 2026. It is likely getting worse because solar demand continues to grow, EV production continues to scale, AI hardware infrastructure continues to be built, and mines cannot keep pace. China and India understand this supply math better than Wall Street does because they are on the ground. They are building the solar farms. They are manufacturing the EVs. They know exactly how much silver they need, and they know the market cannot supply it all. Let me introduce you to something called the COMEX, because this is where the real battle for silver is being fought, and most American retail investors have no idea it even exists. COMEX is the primary exchange in the United States where silver futures are traded. And here is the dirty secret about COMEX. For every 1 physical ounce of silver that exists in their registered vaults, there are potentially hundreds of paper contracts claiming ownership of that same ounce. This is called the paper silver market, and it has been used for decades to suppress the price of silver below where physical supply and demand fundamentals would naturally take it. Here is why this matters right now. When Eastern nations, China, India, and others, buy physical silver directly, they are pulling real metal out of a system that has been running on paper promises. Every bar that leaves a Western vault and travels to Shanghai or Mumbai is a bar that can no longer be used to settle multiple paper contracts. Analysts who track COMEX vault data have been noting something significant over the past 2 years. Registered silver inventories have been under sustained pressure. The registered category is the silver that is actually available for delivery, and it has been declining as physical demand from Eastern buyers continues to absorb supply. This is a slow-motion squeeze. And if it accelerates, if more physical buyers demand actual delivery rather than paper settlement, the COMEX paper price and the real-world physical price could diverge in ways that would shock Western investors. China has been preparing for exactly this scenario. China's SGE, the Shanghai Gold Exchange, has been building its own physical precious metals pricing infrastructure, essentially creating an alternative to COMEX that is backed by real metal rather than paper promises. India has been doing the same through its own commodity exchanges. The East is not just buying silver, it is building a parallel financial infrastructure that does not depend on Western paper markets to determine price. Now let's bring this back to numbers, because this channel is built on data, not hype. Silver has gained 180% since the start of 2025, from roughly $28.92 an ounce at the start of that year to its all-time high of $121.64 in January 2026. Even at today's price of approximately $75 an ounce, after all the panic selling and Hormuz-driven volatility, silver is still up over 150% from where it started just 15 months ago. For context, the S&P 500 has historically returned around 10% per year. Silver just did 150% in 15 months, and yet the Western financial media treats precious metals like a dusty relic, like something your grandfather kept in a shoebox, like an irrational fear trade that sophisticated investors don't need. Tell that to the central banks of Russia, China, and India, who have been accumulating physical gold and silver at a pace not seen since the 1970s. Tell that to the Indian household sector, which purchased record quantities of physical silver in 2025, driven by both cultural tradition and a very rational understanding that their currency needs a hedge. Tell that to the Chinese industrial sector, which consumes silver in quantities that are literally not replaceable by any other material at any price point that makes manufacturing economically viable. The Western investor is making decisions based on fear of a 10-week war. The Eastern investor is making decisions based on a 10-year structural outlook. That is the difference. And it is a gap in understanding that has real financial consequences. Here is another number for you. Analysts at some of the most respected precious metals research firms are now projecting silver prices of $90 to $200 per ounce as the base case for the next 2 to 5 years. Not the bull case, the base case. The scenario that requires no extraordinary events, just the continuation of trends that are already in motion. Solar demand growing, EV production scaling, AI infrastructure expanding, supply deficits compounding, Eastern accumulation continuing. If those projections are even half right, silver at $75 today looks like exactly the kind of discounted entry point that long-term investors dream about. So what does all of this mean for you, sitting here in America, watching the news cycle ping between Hormuz tensions and Federal Reserve drama? It means you are at a decision point. Let me lay out the full picture one more time, clearly and honestly, the way this channel has always operated. Silver hit 121.64 in January 2026, an all-time high. It has since pulled back 34% to approximately $75 an ounce. The pullback was driven by two things: Middle East, conflict pushing inflation, fears higher, and interest rate uncertainty creating pressure on all assets. Both of these are real factors. Neither of them changes the underlying structural story. The structural story is this: silver is in its 5th consecutive year of supply deficit. Industrial demand from solar, EVs, AI hardware, and medical technology is growing faster than mine supply can respond. The largest and fastest growing economies on Earth, China and India, are accumulating physical silver as a matter of strategic and cultural priority. The COMEX paper market is facing increasing pressure from physical delivery demand. And the gold to silver ratio remains historically elevated, suggesting silver has significant catch-up potential relative to gold. Against this backdrop, the current price of approximately $75 per ounce represents either a genuine buying opportunity or a warning sign that something has fundamentally changed in the market. Here is my honest assessment: nothing has fundamentally changed. The Hormuz crisis is real but temporary. Wars end, shipping lanes reopen, inflation pressures ease, but the structural demand for silver does not ease, because solar panels still need silver whether there's a war or not. EV batteries still need silver. AI servers still need silver. What has changed is the price, and a lower price against an unchanged fundamental outlook is what value looks like. Now I want to be clear. I am not your financial advisor. I'm not telling you to buy or sell anything. This channel exists to give you information, context, and analysis that the mainstream financial media is not giving you. What you do with that information is entirely your decision. But I will tell you this. The investors who bought silver at $29 an ounce in early 2025, when everyone said it was dead, when the mainstream said the Fed would keep rates high forever, when nobody was talking about precious metals on CNBC, those investors saw 150% gains in 15 months. The investors who are buying at $75 today, while mainstream media is focused on Hormuz drama, while retail investors are panic selling, while Wall Street is distracted by equity market volatility, those investors may be looking at the next leg of a structural bull market. China sees it, India sees it, central banks around the world see it. The question is whether American retail investors will see it before or after the next move happens. Here is what I want you to take away from today's video. 3 things. First, silver's pullback from $121 to $75 is a sentiment-driven correction in a structurally bullish market. The fundamentals have not changed. Second, Eastern demand is not reactive, it is strategic. China and India are not buying silver because they read a news headline. They are buying because they have done the math on supply deficits, industrial demand, and currency risk, and silver wins that calculation every single time. Third, the gold to silver ratio at 61 to 1 is historically stretched. If it normalizes to even 40 to 1 with gold at current levels, silver would need to be at $114 an ounce. That represents approximately 50% upside from today's price, before accounting for any additional gold appreciation. That is the data. That is the analysis. Make your own decision. If this video gave you a perspective you weren't getting anywhere else, share it. Someone in your circle needs to hear this. Someone is making financial decisions right now without this information. And this channel exists precisely to close that gap. I'm OG, invest with logic, not hype. OG out. While America was distracted by the stock market, the Fed, and crypto headlines, a country of 1.4 billion people quietly made the biggest silver move of the decade, and almost nobody in the West noticed. India just became the #1 silver importer on the planet, bigger than China, bigger than any country in history. In a single year, India pulled in over 9,000 metric tons of silver. That's not a trade. That's not a trend. That is a calculated national strategy. And if you're sitting in the US right now, your financial advisor has not told you a single word about it. I'm OG. And today, we are going inside the numbers that Wall Street does not want you to understand. Let's start with the basics, because if you don't understand what's happening in India right now, you cannot understand where silver is going. Silver is not just a shiny metal. It is the most industrially critical commodity on Earth right now. Solar panels, EV batteries, semiconductors, defense electronics, AI infrastructure. Every single technology that the 21st century is being built on requires silver. There is no substitute. There is no replacement. Silver is irreplaceable, and India knows this. Here's what the mainstream financial media is not covering. In 2024, India's silver imports hit a record-breaking high, approximately 9,145 metric tons. For context, that is nearly double what India imported just 2 years prior. This is not a coincidence. This is not a cultural jewelry purchase. India's industrial sector, its solar manufacturing push, and its government-backed infrastructure programs are all demanding silver at levels that are restructuring the global supply chain in real time. Now let's talk price, because this is where it gets real for you as an investor. When silver was trading in the $26 to $28 range in early 2024, most American retail investors were yawning. They were chasing Nvidia. They were chasing Bitcoin. They were chasing AI stocks. Meanwhile, Eastern buyers, India, China, the Middle East, were quietly accumulating physical silver at every single price dip. Every single one. By April 2025, silver crossed $32, then $34, then it pushed toward the $36 range. And now, as we sit here today, the conversations happening in Mumbai, in Delhi, in Chennai, those conversations are about silver at $50, $60, $74 and beyond, not as a fantasy. As a price target backed by real supply and demand math. Here's the math. And this is the part most people skip because it makes them uncomfortable. Global silver demand hit approximately 1.2 billion ounces in 2023. Global silver mine production, around 820 to 840 million ounces. That is a deficit, a structural annual compounding deficit of over 300 million ounces. And that deficit is growing every single year as industrial demand accelerates and mine supply stagnates. Now layer India on top of that. India's demand is not decreasing, it is not flattening, it is exploding. India's solar installation targets alone require silver at a scale that will put enormous pressure on the already stretched global supply chain. The Indian government has committed to 500 gigawatts of renewable energy capacity by 2030. Every gigawatt of solar power requires approximately 5 to 6 metric tons of silver. Do that math. And here is the critical point. The point that changes everything if you are holding dollars in a savings account right now. India is not importing silver because it has extra money to spend. India is importing silver because it understands that the monetary system is shifting. The dollar is losing purchasing power. Inflation is structural, not temporary. And physical silver, real, tangible, allocated metal, is one of the few assets on Earth that cannot be printed, cannot be inflated away, and cannot be frozen in a bank account. India knows something America doesn't. The question is, what are you going to do about it? Let's talk about what's actually driving this. Because India's silver surge didn't happen overnight. It has been building for years, and the West completely missed the signals. In 2022, India imported roughly 4,900 metric tons of silver. In 2023, that number climbed to approximately 6,800 metric tons. And in 2024, it exploded to over 9,400 metric tons. 3 consecutive years of accelerating demand. 3 consecutive years of Western financial media saying absolutely nothing about it. Why? Because Wall Street's business model depends on you staying in their products. Stocks, bonds, mutual funds, ETFs. The moment you understand what physical silver represents, real money outside the system, their entire revenue model starts to crack. So let's break down exactly where India's silver demand is coming from, because it is not one thing, it is 4 massive forces all hitting at the same time. Force number 1, solar manufacturing. India launched one of the most aggressive solar expansion programs in modern history. Under its national solar mission and subsequent policy frameworks, India is pushing toward 500 gigawatts of installed solar capacity by 2030. Right now, they are at approximately 90 gigawatts. That means India needs to install over 400 more gigawatts of solar panels in the next 5 years. Each gigawatt of solar capacity requires roughly 5 to 6 metric tons of silver for the photovoltaic cells. Run that calculation. That is 2,000 to 2,400 metric tons of silver just from solar every single year for the next 5 years minimum. This demand does not slow down, it accelerates. Force number 2, electronics and semiconductor manufacturing. India is aggressively positioning itself as the next global electronics hub, with Apple, Samsung, and dozens of other manufacturers shifting production out of China and into India. The demand for silver in electronics manufacturing, circuit boards, connectors, switches, batteries, is rising in parallel. Silver is the highest electrically conductive metal on Earth. You cannot build modern electronics without it. Force number 3, jewelry and investment demand. India has a cultural relationship with precious metals that goes back thousands of years. Silver is not just an investment in India. It is savings. It is ceremony. It is generational wealth transfer. When global silver prices dipped in early 2024, Indian retail buyers flooded the market. Physical silver coins and bars sold out across major Indian cities. This demand does not disappear when prices rise. It intensifies, because rising prices validate the purchase decision for the next wave of buyers. Force number 4, monetary hedging. This is the one that most Western analysts completely ignore. India has watched what happened to countries that held too many dollars. It watched Russia's foreign reserves get frozen overnight in 2022. It watched the IMF weaponize financial systems against sovereign nations. India, along with China, the Gulf states, and most of the BRICS bloc, is systematically reducing dollar dependency and increasing hard asset reserves. Silver is part of that strategy. Not all of it, but a growing intentional part. Now here's where it connects directly to your wallet, wherever you're watching this from. When India pulls 9,400 metric tons of silver out of the global market in a single year, that silver does not come back. It goes into solar panels that generate electricity for decades. It goes into electronics that will not be recycled for years. It goes into jewelry vaults and personal savings that will sit untouched for generations. This is called permanent demand destruction from the supply side, and it is exactly what creates the conditions for historic price breakout. Silver at $32, at $36, at $50. These are not ceiling prices. Based on the supply deficit alone, before you even factor in India's demand surge, analysts at major commodity research firms have modeled silver price targets ranging from $50 to $74 within this cycle. And the West is still sleeping, but not for long. Here's the uncomfortable truth that nobody on financial Twitter, nobody on CNBC, and nobody in your brokerage account newsletter is going to tell you. The average American investor has zero allocated to silver. Zero. According to multiple surveys of U.S. retail investor portfolios, precious metals, gold and silver combined, represent less than 1% of total household investment assets in the United States. Less than 1%. Meanwhile, the average Indian household holds approximately 11% of its net worth in physical precious metals. That gap is not cultural. That gap is informational. And that informational gap is what is about to cost millions of Western investors an extraordinary opportunity. And let's talk about what is happening on the supply side, because demand is only half the story. Global silver mine production has been essentially flat for the past decade. The world's top silver-producing nations, Mexico, Peru, China, Russia, and Australia, are collectively producing between 820 and 850 million ounces per year. That number has not meaningfully grown despite silver prices rising. Why? Because opening a new silver mine takes 7 to 10 years from discovery to production. The capital investment is enormous, the regulatory hurdles are significant, and here is the critical detail. Most silver in the world is not mined as a primary product. Approximately 70 to 75% of all silver mined globally comes as a byproduct of copper, zinc, lead, and gold mining. That means silver supply is not controlled by silver prices. It is controlled by the economics of other metals entirely. You cannot simply mine more silver in response to rising demand. The supply chain does not work that way. This structural supply constraint, combined with India's explosive demand growth, is creating what commodity analysts call a perfect squeeze scenario. Now let's bring in the geopolitical dimension, because this is where the India story gets even bigger. India and the United States have a complex relationship. On the surface, they are strategic partners. But underneath, India has consistently refused to join Western economic pressure campaigns against Russia, against China, against OPEC nations. India abstained on UN resolutions condemning Russia. India continued buying Russian oil at discounted prices, while Western nations paid premium prices for energy. India is playing its own game on the global chessboard, and silver is one of the pieces. Here is something even more significant that happened quietly in late 2024 and into 2025. India began accelerating its bilateral trade agreements with multiple countries, agreements designed specifically to reduce dollar settlement in commodity trades. India and Russia are now settling significant portions of their oil trade in rupees and rubles. India and several Gulf nations are exploring dirham and rupee settlement frameworks. Every trade deal that moves away from dollar settlement is a deal that incrementally reduces global dollar demand and incrementally increases the appeal of hard assets like silver and gold as neutral reserve stores of value. And now, connect this to what gold has already done. Gold crossed $2,000 per ounce in 2023. It crossed $2,400 in early 2024. By late 2024 and into 2025, gold was trading above $3,000 per ounce, a level that would have seemed impossible to most analysts just 2 years prior. Central banks globally purchased over 1,000 metric tons of gold in both 2022 and 2023, the highest central bank gold buying on record in modern history. The largest buyers? China, India, Turkey, Poland, nations that are deliberately building hard asset reserves outside the dollar system. Now look at the gold to silver ratio. Historically, the gold to silver ratio has averaged between 15 to 1 and 47 to 1 over the past century. Today, that ratio sits at approximately 85 to 1, meaning silver is dramatically underpriced relative to gold by every historical measure. If silver were to simply revert to its historical average ratio of 47 to 1, with gold at $3,000, silver would be priced at approximately $63 per ounce. If the ratio moves to 30 to 1, which has happened before in bull markets, silver at $3,000 gold means a silver price of $100 per ounce. These are not predictions. These are ratio mathematics. And India already ran the numbers. That is exactly why they're buying. That is exactly why their government-linked institutions, their private sector manufacturers, their retail investors, and their central banking system are all moving in the same direction at the same time. The East does not make trillion-dollar commodity bets by accident. They make them because the math works. So let's bring this all together. Because everything we have covered in this video leads to one unavoidable conclusion that you need to sit with before you close this tab. India did not stumble into becoming the world's largest silver importer. This was not an accident of markets. This was not a one-time trade anomaly. This was a deliberate, coordinated, multi-year national strategy executed by a country of 1.4 billion people that has watched the Western financial system very carefully and decided to position itself outside of it. Think about what that actually means. When a country of India's scale makes a sovereign-level bet on silver, importing over 9,400 metric tons in a single year, it is sending a signal to every other nation watching. And those nations are watching. The Gulf states are watching. Southeast Asia is watching. Africa's fastest-growing economies are watching. The message is clear. Silver is not a relic. Silver is not a boomer trade. Silver is the industrial backbone of the 21st century economy, and the monetary hedge of the new world order that is forming right now beneath the surface of the mainstream financial narrative. Now let's talk about what this means specifically for you, because information without action is just entertainment. If you're holding cash in a savings account right now, you need to understand what is happening to that cash in real terms. The Federal Reserve has printed trillions of dollars since 2020. The U.S. national debt has crossed $34 trillion and is accelerating. The purchasing power of the dollar has declined significantly in just the past 4 years. Food costs more, rent costs more, energy costs more, healthcare costs more. This is not a temporary blip. This is a structural monetary debasement that is ongoing, and that will continue regardless of which political party controls Washington. Physical silver, real, allocated, in-your-hand silver, is one of the few assets that exists completely outside that system. It cannot be printed. It cannot be digitally created. It cannot be confiscated through inflation. And right now, it is still priced at levels that represent one of the most asymmetric risk-reward opportunities in the modern commodity market. At $32 per ounce, silver is still below its all-time high of approximately $50 set back in 1980, and again briefly in 2011. Adjusted for real inflation, not the CPI number the government reports, but actual purchasing power decline, silver's inflation-adjusted all-time high is somewhere between $150 and $200 per ounce. That is how undervalued silver is in real monetary terms. That is the gap between where silver is today and where honest mathematics says it should be. And India already did that math. China already did that math. Russia already did that math. The question is, when does the American retail investor do that math? Because here is the reality. When the West finally wakes up to the silver story, when the mainstream financial media starts covering India's demand surge the way they cover tech stocks, the easy gains will already be gone. The physical metal will already be locked away in solar panels. In electronics, in private vaults from Mumbai to Dubai to Shanghai, the supply will be tighter than it has ever been. And the price will reflect a market that moved while most people were watching CNBC tell them everything was fine. This is not fear-mongering. This is not hype. These are numbers. These are facts. These are trends that are already in motion and cannot be reversed. India made its move. The East made its move. Now, the only question that matters is, are you going to make yours? Because sitting on the sidelines while the greatest silver transfer in modern history happens around you is not a neutral position. Inaction is a choice. And in this market, that choice has a price. Do your own research. Talk to a qualified financial advisor. Look at the data with your own eyes. But whatever you do, don't say nobody told you. Invest with logic, not hype. OG out. Silver just crashed. 9% in a single day. If you woke up this morning and checked your portfolio, you already felt it. Silver dropped from $88 an ounce all the way down to $76. That's not a dip, that's a warning shot. And most Americans have no idea where it came from. But here's what nobody on Wall Street is talking about. The country that was supposed to save silver, the country that just placed a $6 billion bet on this metal, just turned around and taxed its own people out of buying it. India, the world's largest consumer of silver, the nation that single-handedly moved silver prices with its industrial demand, its solar panel factories, its jewelry markets, its middle class buying physical metal by the ton. India just raised its silver import tariff from 6% to 15%. And let that sink in. When your biggest customer suddenly makes it harder for its own citizens to buy your product, you don't celebrate. You ask why. And that question, why, is exactly what this video is going to answer. Because once you understand what India actually did here, and more importantly why they did it, the $76 crash starts to look less like a disaster and more like the most obvious setup you've ever seen. My name is OG, and if you've been watching this channel, you already know how this plays out. The East makes a move. The West calls it a crash. And by the time America figures out what happened, the window is already closed. Let's go back to just 5 days ago. Silver was riding high, $81, $86, then $88. Every headline was bullish. Every analyst was revising their targets upward. Goldman Sachs had silver in the $85 to $100 range for 2026. Citigroup had a second-half target of $110. Bank of America, and this is the one that made jaws drop. Bank of America put out a year-end range of $135 to $309 per ounce. $309. And then, in the same week those targets were circulating, silver lost 9% in one session. That's not a coincidence. That's a test. Here's what actually triggered the crash. U.S. inflation data came in hot. Producer prices, import prices, export prices, all surging faster than expected. The Federal Reserve, which was supposed to be cutting interest rates this year, is now being priced out of any cuts at all. Some traders are even betting on a rate hike by December. When rate hike expectations rise, precious metals fall. That's the mechanical relationship. That's what caused the immediate drop. But inflation didn't come from nowhere. It came from the Iran war. It came from the ongoing closure of the Strait of Hormuz, which has choked global energy flows and pushed fuel costs through the roof. The geopolitical chaos that was supposed to be bullish for silver, and it was all the way up to $88, is now being used as a reason to sell. This is how the game works. The headline says, silver crashed. The fine print says the world's largest silver buyer just changed the rules. And when the rules change, you don't panic. You pay attention. Because India didn't raise that tariff to hurt silver. India raised that tariff because they have a plan. And that plan doesn't include letting retail investors, foreign or domestic, front-run them. The trap isn't silver. The trap is thinking this crash is the story. Let's talk about what India actually did, and why the timing is everything. On the surface, raising a silver import tariff from 6% to 15% looks like a government trying to protect its foreign exchange reserves. India spends billions importing silver every year. When silver was at $30 an ounce, that was manageable. When silver hit $88, well, that import bill became a serious problem for the rupee. So the government stepped in and made it more expensive to bring silver into the country. That's the official explanation. That's what you'll read in Reuters. That's what the analysts on CNBC will tell you. But here's what they won't tell you. India has been stockpiling silver for years, not through its citizens, not through retail purchases, through government-linked industrial channels, through its solar manufacturing program, through defense contracts, through the very supply chains that don't show up in standard import data. When India raised that tariff, it didn't stop silver from coming in. It stopped the wrong people from bringing it in. Think about what that means. India's government essentially said, we know what silver is worth. We know where this price is going. And we are not going to let speculators, arbitrage traders, or foreign capital front-run us on the way up. The tariff is a gate, and the gate is only closed to retail, the big industrial buyers, the solar panel manufacturers, the electronics companies, the defense suppliers. They operate under different frameworks, long-term contracts, government procurement channels, bilateral trade agreements. The 15% tariff barely touches them. But the individual Indian investor, the middle-class buyer who saw silver go from $30 to $88 and wanted in, that person just got priced out. And here is where it gets interesting for you, sitting in America, watching this play out from the outside. India's silver demand was one of the primary engines driving this rally. The Silver Institute reported that India's industrial silver consumption has been growing at a rate that no other country can match. Their solar panel installation targets alone require millions of ounces of silver annually. That demand was not going away. It was accelerating. So what does a 15% tariff do to that demand story? In the short term, and this is critical, it creates a price dip. Traders who were long silver based on India demand suddenly see a reason to exit. The algorithms pick it up. The momentum shifts. Silver drops. That's exactly what happened this week alongside the inflation data. Two narratives hit at the same time and silver got sold off hard. But the underlying demand didn't disappear. India still needs silver. Its factories still need silver. Its government's solar ambitions, which are tied directly to geopolitical positioning against China, still require silver. A tariff doesn't change the physics of solar panels. Silver's electrical conductivity doesn't care about import duties. What the tariff does is create a temporary illusion of demand destruction. And temporary illusions in commodity markets are where the real money gets made. UBS just slashed their silver demand forecast from 400 million ounces to 300 million ounces. They cited demand destruction at elevated prices. They cited the India tariff specifically. Their year-end target dropped to $80. UBS said, sell. Citigroup said $110 by the second half of this year. Bank of America said $309. Three major institutions. Three completely different readings of the same market. That kind of disagreement doesn't happen when things are normal. That kind of disagreement happens when something structural is shifting underneath the surface, and not everyone can see it yet. India can see it. That's why they built the trap. Here's the part that should make every American investor uncomfortable. While India was quietly restructuring its silver access channels, while China was positioning through industrial procurement, while central banks across Asia were adding to their hard asset reserves, American retail investors were watching CNBC debate whether the Fed would cut rates in September. That's the gap. That's always been the gap. The West trades silver like it's a financial instrument, a ticker, a line on a chart that goes up when inflation is high and down when the dollar strengthens. And that framework isn't wrong. It's just incomplete because it misses the physical layer entirely. It misses the fact that silver is not just a hedge against inflation. Silver is infrastructure. Silver is the material that the next century of energy is being built on. Every solar panel produced anywhere in the world contains silver, not a little silver, a meaningful, irreplaceable amount of silver. The electrical contacts, the conductive paste, the grid lines that collect and move energy across the panel surface, all of it depends on silver's unique properties. No other metal does what silver does at the efficiency levels that modern solar manufacturing requires. JP Morgan's own analysts flagged a potential long-term risk, the development of silver-free solar technology using cadmium telluride thin film. And yes, that technology exists, but here's the reality check. Cadmium telluride panels are less efficient. They require more surface area to generate the same power. And in a world where every square meter of solar installation is being optimized for maximum output, efficiency losses are not acceptable. Not for India's grid targets, not for China's manufacturing base, not for the utility scale projects being built across Southeast Asia right now. The silver-free solar panel is not coming in time to change the supply equation for this decade. And this decade is the one that matters. So why is the American market reacting to this week's crash like silver is finished? Because American investors are looking at interest rates. They're looking at the Fed. They're looking at the inflation print and calculating that if rate cuts are off the table, precious metals have no near-term catalyst. That calculation is correct in a paper market. It is dangerously incomplete in a physical market. The physical silver market has been running a supply deficit for years. Mine supply is not keeping up with industrial demand. The largest silver-producing nations, Mexico, Peru, China, are not suddenly going to double their output because prices are high. Mining takes years. New deposits take decades. The supply side of this equation is essentially fixed in the near term. And on the demand side, you have India, which just made it harder for retail to buy but left industrial channels wide open. You have China, which closed its retail silver fund last month, a move that looked bearish on the surface but actually signaled that the government wanted to consolidate physical holdings rather than let speculative money drive the price prematurely. You have central banks across the global south quietly diversifying away from dollar-denominated assets into hard commodities. The West sees a crash. The East sees a discount window. And that $76 price right now, after hitting 88 just days ago, that is not a sign that silver's story is over. That is the market offering a re-entry point that 3 months from now, people will be writing articles about. The question isn't whether silver recovers. The question is whether you understand enough about why it crashed to trust the recovery when it comes. Because the India trap was never set for silver investors. It was set for everyone who panics when silver drops 9% in a day. So where does silver go from here? Let's put actual numbers on the table, because that's what this channel does. Not vibes, not speculation. numbers with reasoning behind them. Silver is sitting at $76 today. It was at $88 6 days ago. That $12 drop happened because of two simultaneous events: hot U.S. inflation data that killed rate cut expectations, and India's tariff announcement that spooked demand-side traders. Both of those events are real. Neither of them changes the structural story. Here is what the institutions are saying right now. JP Morgan has a full year 2026 average of $81 per ounce. Silver is already below that average, which means either JP Morgan revises upward, or silver spends the second half of this year significantly above 81 to bring the annual average back up. Either outcome is bullish from current levels. Goldman Sachs is projecting an $85 to $100 range for 2026, with silver classified as a primary strategic metal of the green energy transition. Goldman doesn't use that language loosely. When Goldman Sachs calls something a strategic metal, institutional money follows. Citigroup has a second half target of $110, citing acute physical supply shortages, not demand forecasts, not projections, physical shortages, metal that isn't there when buyers come looking for it. And then there's Bank of America, $135 to $309. That is the widest institutional forecast range ever published for a major commodity. And that range exists because Bank of America is not just modeling supply and demand. They are modeling what happens when the gold to silver ratio compresses in a genuine bull market. At the peak of the 2011 silver rally, the ratio hit 31 to 1. Right now it sits at approximately 55 to 1. If that ratio compresses toward historical bull market levels and gold holds anywhere near its current price, the math on silver becomes genuinely difficult to argue with. Now let's talk about what you actually do with this information. First, understand what this crash is. It is a sentiment-driven event layered on top of a macro trigger. The inflation data was real. The rate hike fears are real. But sentiment-driven sell-offs in structurally undersupplied markets have a consistent historical pattern. They create the exact entry points that long-term holders look back on and call obvious. Second, watch India, not the tariff. Watch the industrial data, watch the solar installation numbers, watch whether Indian government procurement of silver through industrial channels increases over the next 60 to 90 days. If it does, the tariff story was exactly what it looked like: a gate to keep retail out while institutions loaded up. Third, watch the COMEX. Physical delivery requests on silver futures contracts are one of the cleanest signals available. When paper traders are selling and physical buyers are taking delivery, the disconnect between paper price and physical reality tends to resolve in one direction. It is always resolved in one direction. The India trap is real. But the trap wasn't designed to catch silver investors. It was designed to catch the people who see a 9% drop and assume the story is over. The people who sell at 76 because 88 felt too high 3 weeks ago. That is exactly the psychology that moves wealth from one group of people to another. The East understands silver as infrastructure. The West trades it like a meme. And until that changes, the arbitrage between those two worldviews is where the real opportunity lives. $76, physical supply deficit, institutional targets between 100 and 309, India locking retail out of its own market. You tell me if the story's over. Invest with logic, not hype. OG out. Nobody wants to say it out loud. Not the Fed, not Wall Street, not the politicians running their mouths on cable news every single night. But silver knows. Silver has always known. And right now, quietly, without headlines, without breaking news alerts, silver is sending a warning so loud that the biggest banks on the planet are paying very close attention. The question is, are you? Here's what they're not telling you. While you were watching stock tickers, refreshing your 401k, and debating whether the economy is slowing down or just taking a breather, a completely different story was unfolding in the physical metals market. A story written not in press releases or Fed statements, but in ounces. Real, tangible, hold it in your hand silver. And that story says one thing very clearly. The recession is already here. It just hasn't been officially named yet. Let's talk about what a recession actually looks like before the government admits it exists. Historically, and going back decades, precious metals don't wait for official announcements. They don't wait for 2 consecutive quarters of negative GDP. They move on instinct, on pressure, on the kind of financial stress that builds up beneath the surface long before it cracks through. Gold crossed $3,000 an ounce earlier this year. That wasn't an accident. That was institutional money, big money, quietly repositioning. And silver? Silver told an even wilder story. On January 29th, 2026, silver hit an all-time high of $121.64 per ounce, the highest nominal price in the metal's entire recorded history. Think about that for a second. Not 1980, not 2011, 2026. And then, almost overnight, it crashed back down to the 70s. Was that a bubble popping? Was that manipulation? Or was that the loudest economic signal hiding in plain sight that most people completely missed? We're going to break it all down. Here's a number I want you to hold on to for this entire video. 2,200 ounces of silver. That's approximately how many ounces of silver it took to buy the average American home at the peak of the last great silver bull market back in 1980. Now fast forward to today. The median U.S. home price sits at approximately $420,000. Silver is trading around $78 per ounce. You do the math. To buy that same median home today in silver, you would need roughly 385 ounces. That's not a small difference. That is a gap so enormous, it tells you one of two things is completely out of line with historical reality. Either housing is obscenely overpriced, or silver is catastrophically undervalued. And here's the thing. The data suggests it might actually be both. Now, here's where it gets interesting. And this is the part that most YouTube channels won't touch because it requires digging past the surface. While retail investors were panic selling silver during that January crash, watching it fall from $121 all the way back to $69 in a matter of days, something completely different was happening on the institutional side. Bank of America's head of metals research, Michael Widmer, did not flinch. He kept his silver price target at a range of 135. They make them because they're traders. They're analysts. Their risk departments are looking at data the average investor never sees. And what they're seeing in that data is pointing straight at one conclusion. The physical silver market is under a level of stress that historically precedes major economic dislocations. In plain English, something big is coming, and silver already knows what it is. Let's talk about something called registered inventory. Most people have never heard of it, and that's exactly why it's so powerful when you understand what it means. COMEX, the commodity exchange in New York, is where silver futures are traded. Billions of dollars worth of silver contracts change hands there every single day. But here's the dirty secret that Wall Street hopes you never figure out. Most of that silver doesn't actually exist, not in any physical sense that matters. What exists on paper and what exists in the vaults are two completely different numbers. And right now, that gap has reached a level that exchange analysts themselves are flagging as, and I'm quoting directly here, stress territory. As of late March 2026, COMEX registered silver inventory, meaning the physical silver that is actually available for immediate delivery, had fallen to approximately 76 million ounces. Sounds like a lot, right? It isn't. That 76 million ounces represents just 13.4% coverage of total open interest on the exchange. Think about what that means in real terms. If even a fraction of the paper silver holders on COMEX decided they wanted actual physical delivery, actual bars, not contracts, the exchange could not cover it. This is not speculation. This is the exchange's own data. And it gets worse. In the March 2026 delivery cycle alone, approximately 9,212 contracts were presented for physical delivery. That translates to roughly 46.1 million ounces of physical silver demanded in a single month. Do the math. That single delivery cycle absorbed approximately 60.6% of the entire registered stock in 1 month. 1 month. The registered inventory drawdown has been accelerating since late 2025. This isn't a blip. This isn't a seasonal fluctuation. This is a structural drain that has been building quietly while the financial media was busy talking about tech stocks and crypto. When physical silver is leaving COMEX vaults at this rate, it means someone, somewhere, is pulling real metal out of the system, not trading paper, not speculating, actually taking possession of physical silver at scale. That is institutional behavior. That is not retail panic buying. Here is another number that should be making front page news, but somehow never does. The Silver Institute, the most authoritative body tracking global silver supply and demand, has confirmed that 2026 is projected to be the 6th consecutive year of global silver supply deficit. 6 years in a row where demand has exceeded what mines can produce. The 2025 shortfall alone reached an estimated 95 million ounces. The cumulative 5-year gap from 2021 through 2025 is approximately 820 million ounces, roughly equivalent to 1 full year of total global mine output wiped out by demand. And mine supply cannot close this gap quickly. Global silver production has held relatively flat at around 813 million ounces annually. Ore grades are declining. New project pipelines are thin. And here is the critical detail. Approximately 70% of silver is mined as a byproduct of gold, copper, and zinc mining, which means silver output does not respond to price signals the way primary metals do. You cannot simply turn on a new silver mine because the price went up. The supply side is essentially fixed, and the demand side is going in one direction only. Silver is not just a monetary metal anymore. That ship sailed years ago. Today, silver is embedded in the foundation of the modern industrial economy in ways that cannot be substituted away cheaply or quickly. Solar panel manufacturing alone accounts for roughly 16% of annual global silver demand, and that share grows every single year as solar installations set new records globally. Electric vehicles, 5G infrastructure, semiconductor manufacturing, AI data centers, medical devices. Every single one of these industries requires silver, and every single one of them is growing. The Silver Institute and Oxford Economics project that solar, EV, and data center applications alone will drive industrial silver consumption materially higher through 2031. Now combine that with a sixth consecutive supply deficit. Combine that with COMEX registered inventory at stress levels. Combine that with institutional price targets between $135 and $300. And then ask yourself one simple question. Why is nobody on mainstream financial media connecting these dots? The answer to that question tells you everything you need to know about who benefits from silver staying quietly undervalued, and who gets left behind when it doesn't. Let's get something straight right now. The word recession has become almost politically radioactive. Nobody in an official capacity wants to say it. Not the Treasury Secretary, not the Federal Reserve Chair, not the major bank CEOs who show up on CNBC every quarter with perfectly rehearsed optimism. But markets don't care about politics. Markets don't care about narratives. Markets price in reality, sometimes months before reality officially arrives. And silver's behavior over the past 18 months has been screaming a very specific message to anyone paying attention. Here is the pattern that has repeated itself across every major economic dislocation in modern history. Silver surges aggressively as institutional money repositions ahead of a crisis. Then it sells off violently as liquidity gets squeezed and traders are forced to dump anything with a profit to cover losses elsewhere. Then, once the monetary policy response kicks in, once rate cuts begin, once the dollar weakens, silver launches into its most powerful phase. That is exactly the sequence playing out right now. The surge happened January 2026. $121.64 per ounce, all-time high. The violent sell-off happened. Silver crashed nearly 43% from that peak in a matter of weeks. And now, silver is consolidating, holding, building a base. The third phase, historically the most explosive phase, has not happened yet. Here's the recession signal that banks are watching most closely, and it has nothing to do with silver's price chart directly. It has everything to do with the Federal Reserve's impossible position. As of right now, the Fed funds rate sits at 3.50 to 3.75%. The CME Group's own data showed essentially a 0% probability of a rate cut in April. Markets are now pricing in perhaps one cut by December at the earliest. Why does this matter for silver? Because the Fed is caught in a trap that gets tighter every single month. On one side, inflation. The Iran conflict has pushed oil prices higher. Supply chain disruptions continue. Core PCE remains stubborn. If the Fed cuts rates now, it risks reigniting inflation that it spent years trying to crush. On the other side, a slowing economy. GDP growth is softening. Consumer debt is at record levels. Credit card delinquencies are climbing. Corporate earnings guidance is getting revised downward across multiple sectors. Cut rates, inflation comes back. Hold rates, the economy breaks. This is the definition of a central bank trapped between two catastrophic outcomes. And when central banks are trapped, historically, without a single exception, hard assets win. Gold wins. And silver, which amplifies gold's moves in both directions, wins even harder. JP Morgan's own data showed silver's amplification pattern clearly during the March 2026 volatility. When gold fell approximately 6% over 2 sessions, silver dropped nearly 20%. The same amplification that crushed silver on the way down will launch it dramatically on the way up. Now let's talk about the metric that sophisticated precious metals investors track more closely than the price of silver itself, the gold to silver ratio. Right now, that ratio sits at approximately 64 to 1, meaning it takes 64 ounces of silver to buy 1 ounce of gold. The long-run historical average is 55 to 60 to 1. At the COVID crash peak in March 2020, that ratio hit 126 to 1, the most silver had ever been undervalued relative to gold in modern history. Silver then went on to gain 700% from that low to its January 2026 all-time high. At the 1980 silver peak, that ratio compressed all the way down to approximately 17 to 1. 17 ounces of silver to buy 1 ounce of gold. If gold continues its institutional-driven march toward the $4,000 and $5,000 targets that Goldman Sachs and others have publicly stated, and if the gold-to-silver ratio compresses even partially back toward historical bull market norms, the math for silver becomes extraordinary. At a 30 to 1 ratio with gold at $4,000, silver would be priced at $133 per ounce. At a 20 to 1 ratio with gold at $5,000, silver would be priced at $250 per ounce. These are not fantasy numbers. These are the outputs of ratios that have played out in living memory. Remember that number from the beginning? $2,200 ounces, the historical average number of silver ounces required to purchase a median American home at the peak of a silver bull market. For 2,200 ounces of silver to buy today's median home at $420,000, silver would need to reach approximately $190 per ounce. Bank of America's floor target for 2026 is $135. Their ceiling target is $309. At $190 silver, which sits comfortably within the institutional forecast range, a person holding 2,200 ounces of physical silver would have the purchasing power to buy a home outright. Not with a mortgage, not with 30 years of interest payments, not trapped in rent forever, with silver. That is not a coincidence. That is the monetary reset that history keeps rhyming toward. And the banks watching silver's every move understand this better than anyone. History does not repeat itself exactly, but it rhymes with a precision that should make every person watching this video pay very close attention. Let's go back to 1971. That was the year President Nixon closed the gold window, ending the direct convertibility of the US dollar into gold. It was the moment the United States officially moved to a pure fiat currency system. No gold backing, no silver backing, just government promises printed on paper. In 1971, the average American home cost approximately $25,000. At silver's price at the time, around $150 per ounce, that same home would have cost you roughly 16,000 ounces of silver. Then the 1970s happened. Inflation exploded. The dollar lost purchasing power at a rate that devastated ordinary American families. Oil shocks, stagflation. Sound familiar? By January 1980, silver had surged to $49.45 per ounce, a 3,200% increase from its 1971 baseline. And at that peak, the average American home, which had also risen in dollar terms to around $47,000, cost approximately 1,000 ounces of silver. Silver had so dramatically outpaced housing that ordinary people who had been stacking physical silver through the 1970s found themselves holding enough metal to purchase real estate outright. That is not ancient history. That is within living memory. The conditions building right now, a dollar under structural pressure, a Federal Reserve trapped between inflation and recession, 6 consecutive years of silver supply deficits, COMEX registered inventory at stress levels, and institutional banks publicly targeting silver between $135 and $309 are more aligned with that 1970s setup than any period since. There is a rule in financial markets that separates sophisticated investors from everyone else. Never watch what institutions say, watch what they do. The iShares Silver Trust, ticker SLV, the largest silver ETF in existence with approximately $46 billion in assets under management, recorded daily trading volumes of 175 million shares during the January 2026 volatility. That is not retail investors. That is institutional positioning at a scale that dwarfs ordinary market participation. JP Morgan, the same institution that has faced scrutiny for decades over its activities in the silver futures market, has been consistently building its physical metals exposure. Central banks globally added over 1,000 tons of gold for the third consecutive year in 2025, the highest sustained pace of central bank gold accumulation in modern history. When central banks stack gold at record pace, silver follows. It always has. The silence around silver in mainstream financial media is not accidental. It is a feature, not a bug. The window of undervaluation, and make no mistake, silver at $78 with $309 institutional targets, is still a window. It does not stay open indefinitely. So let's bring everything together. Silver hit an all-time high of $121.64 in January 2026 and then crashed 43%, not because the fundamentals broke, but because leveraged paper traders were forced to sell during a liquidity squeeze. The physical market told the opposite story. COMEX deliveries accelerating, registered inventory draining, institutional money quietly accumulating. The Federal Reserve is trapped between inflation and recession, the exact monetary environment that has historically been the most powerful catalyst for precious metals. The gold to silver ratio at 64-1 suggests silver remains historically discounted relative to gold, and ratio compression during bull markets has historically produced the most explosive silver price moves. 6 consecutive annual supply deficits with industrial demand from solar, EVs, AI infrastructure, and semiconductors growing every single year means the structural foundation underneath silver is stronger today than it has ever been. And the silver to housing ratio, that 2,200 ounce benchmark from the last great monetary reset, suggests silver would need to reach approximately $190 per ounce to restore the historical relationship between real money and real assets. Bank of America says $309 is on the table. The banks are watching. The vaults are draining. The Fed is cornered. And silver, quiet, patient, and completely unbothered by whatever the financial media decides to talk about today, is simply doing what it has always done throughout monetary history. It is telling the truth. The only question left is whether you are listening. Invest with logic, not hype. OG out. Right now, as you are watching this video, there is a narrow strip of water, just 21 miles wide, that is deciding the future of silver prices, and the country that controls it just made a decision that Wall Street did not see coming. Iran opened the door, but not for America. China sailed through, India sailed through, Russia sailed through, and the United States, the world's most powerful navy, is sitting outside, watching, blocked. And silver? Silver just jumped over 6% in a single day to $85 an ounce. That is not a coincidence. That is a signal. Let me show you exactly what happened, why it happened, and what it means for every single dollar you have sitting in silver or gold right now. The Strait of Hormuz. You have heard this name before, but let me give you the number that actually matters. 27% of the world's entire seaborne oil trade moves through this one choke point every single day. 27%. Ships from Qatar carrying liquefied natural gas. Tankers from Saudi Arabia, Kuwait, Iraq, the UAE. All of it through one narrow corridor between Iran and Oman. Since February 28th of this year, that corridor has been effectively closed. The United States and Israel launched military operations against Iran. Iran's supreme leader was killed, and in retaliation, Iran did something no country has done in modern history. It shut down the world's most critical energy shipping lane. But here's the part the mainstream financial media is glossing over completely. Iran did not close the strait for everyone. It closed it for the West. On March 26th, Iran's foreign minister announced that ships from 5 specific nations would be allowed to transit the Strait of Hormuz freely. 5 nations: China, Russia, India, Iraq, Pakistan. Read that list again. Because that is not a random selection. That is a geopolitical statement written in maritime law. Iran just drew a new map of the world, and America is not on the friendly side. Now ask yourself this. If China can move its ships, its cargo, its energy supplies freely through Hormuz, and American allied shipping cannot, what does that do to the global balance of trade? What does that do to oil prices in the West? What does that do to inflation? And most importantly, what does that do to silver? The answer is already showing up in the price. $85 an ounce, 6% in one day. That is not normal market movement. That is the market processing a fundamental shift in who controls the world's energy supply chain. And this is just the beginning. Because on Monday, President Trump looked at Iran's latest peace proposal and called it, in his own words, totally unacceptable. The ceasefire that briefly gave markets hope, Trump said it is on massive life support, which means the strait stays closed, which means oil prices stay elevated, which means inflation in America is not going away, and which means the Federal Reserve, already trapped, just got pushed deeper into a corner it cannot escape from. We are going to break all of this down. The Iran-China deal that nobody is calling a deal. The silver price mechanics that Wall Street does not want retail investors to understand. And the number, the one specific price level, that tells you exactly where silver is heading if this strait stays closed for another 60 days. Stay with me, because this is where it gets serious. Let us talk about what China just won. Because, make no mistake, this was not an accident. This was not Iran being generous. This was a calculated geopolitical move that China has been positioning for since the moment this conflict began. When the US and Israel launched operations against Iran in late February, the entire world held its breath. Energy markets panicked. Brent crude surged 10 to 13% in a single week. Qatar, which supplies roughly 20% of the world's liquefied natural gas, declared force majeure on its export contracts. That means they legally walked away from their delivery obligations because the situation was beyond their control. European gas benchmarks nearly doubled. The European Central Bank immediately postponed its planned rate cuts. Germany, Italy, already on the edge, were suddenly staring at potential recession by the end of 2026. Now, who benefits when the West's energy supply chain collapses? China had a plan. While Western shipping companies suspended operations in the strait, China maintained back-channel communication with Tehran. While American diplomats were demanding Iran reopen the waterway unconditionally, Chinese officials were quietly negotiating a separate arrangement. The result? Chinese vessels move freely. Chinese factories keep running. Chinese solar panel manufacturers, who consume more silver per year than almost any other single industry on the planet, keep their supply chains intact. And here's where silver enters the picture in a way that most analysts are completely missing. China is the world's largest consumer of silver for industrial applications. Solar panels alone require approximately 20 grams of silver per panel. China installed more solar capacity last year than the entire rest of the world combined. That demand does not stop because of a conflict in the Middle East. If anything, China's ability to move freely through Hormuz while Western competitors are locked out gives Chinese manufacturers a supply chain advantage that translates directly into continued silver purchases at scale. Meanwhile, on the American side of this story, the picture could not be more different. U.S. inflation came in at 3.8% for April 2026. That is the highest reading since May 2023. And it was not just headline inflation. Core inflation, which strips out food and energy, also came in above expectations at 2.8%. Think about what that means for the Federal Reserve. Jerome Powell's departure already created uncertainty, but regardless of who sits in that chair right now, the math is the same. You cannot cut interest rates when inflation is running at 3.8% and rising. But you also cannot raise rates aggressively when the manufacturing sector is already contracting and job growth is slowing. The Fed is trapped, completely trapped. And historically, every single time the Federal Reserve has been caught in this stagflation trap, silver and gold have performed, not because of speculation, because of mathematics. When real interest rates are negative or near zero, meaning inflation is higher than the return you get from holding cash or bonds, hard assets become the logical alternative. Silver at $85 today is not expensive. It is catching up. Goldman Sachs currently holds a year-end 2026 price target for gold at $5,400 per ounce. That is not a fringe forecast. That is one of the largest financial institutions in the world telling its clients that the current environment, stagflation, geopolitical disruption, dollar weakness, is structurally bullish for precious metals. And where gold goes, silver follows. But silver moves faster. Silver moves harder. Because silver is not just a store of value. It is an industrial metal in a world that is accelerating its need for exactly the technologies silver powers. The question is not whether silver goes higher. The question is whether you understand why before the next move happens. Now, let us talk about the number that actually matters. Not $85, that is today's price. I want to talk about what happens to silver if the Strait of Hormuz stays closed for another 60 days, because the market has not priced that scenario in yet, not fully. Here's how the mechanism works. Hormuz stays closed. Oil prices stay elevated. We are talking Brent crude pushing toward and potentially past $120 per barrel, which we already saw briefly in March. Higher oil means higher transportation costs across every supply chain on Earth. Higher transportation costs mean higher input costs for every manufacturer. Higher input costs mean higher consumer prices. Higher consumer prices mean inflation does not come down. Inflation does not come down means the Fed cannot cut. Fed cannot cut means bond yields stay elevated. Elevated bond yields create pressure on the dollar. Dollar weakness is historically one of the single strongest tailwinds for silver prices. This is not a theory. This is a chain of cause and effect that is already in motion. The ISM Manufacturing Prices Paid Index, which measures what American factories are actually paying for their inputs right now, came in at 84.6 for April. That is up from 78.3 in March. That is the highest reading since April 2022. And the 3-month surge in that index, 25.6 percentage points, is the largest in the entire history of that data series. In plain English, American manufacturing is experiencing input cost shock unlike anything in recent memory. And it is happening while the employment component of that same index is falling, meaning factories are paying more for materials while hiring fewer workers. That is stagflation. Confirmed. In the data, not in a forecast. In the actual numbers coming out of American industry right now. And here is what stagflation does to precious metals. In the 1970s, the last major stagflation period in American economic history, silver went from approximately $1.50 per ounce to nearly $50 per ounce over the course of that decade. That is a 3,300% move. Gold went from $35 to over $800. These were not speculative bubbles. These were rational market responses to an environment where holding cash was a guaranteed losing proposition. We are not in the 1970s. The numbers are different. The scale is different. But the structural dynamic, inflation the Fed cannot fight without causing recession, combined with geopolitical disruption to energy supply, is the closest parallel this market has seen in 50 years. Now add the China-Hormuz factor on top of that. China is not just buying silver through its manufacturing sector. Chinese institutional investors have been accumulating physical silver in Shanghai at an accelerating pace. The Shanghai Futures Exchange, where silver trades separately from the Western COMEX market, has seen delivery volumes surge. When East and West price silver differently, and when Eastern buyers have physical access to supply, the Western buyers are competing for. The arbitrage pressure pushes prices in one direction, up. The analysts who are calling $85 a ceiling are looking at silver the way Western institutions always look at silver, as a speculative commodity that trades against gold. They are missing the industrial demand story, they are missing the China supply chain story, and they are missing the geopolitical story that is playing out in real time in 21 miles of Iranian-controlled water. We are not at the ceiling. We are at the beginning of the next leg. So where does this leave you? Let me be direct. This channel does not give financial advice. What we do is read the data, follow the logic, and present what the numbers actually say, not what Wall Street wants retail investors to believe. And right now the numbers are saying something very specific. The investors who are going to look back at May 2026 and wish they had paid attention are not the ones who did not know silver was at $85. They are the ones who knew the price, but did not understand the structure underneath it. They saw the number and thought it was already too late. They did not see the mechanism. They did not understand why China sailing through Hormuz while America sits blocked outside is not just a geopolitical story. It is a silver story. Let me give you the full picture one more time, so it is locked in. Iran controls the world's most critical energy choke point. Iran has chosen to allow Eastern nations, China, Russia, India, to transit freely while blocking Western shipping. This creates a two-tier global economy where Eastern manufacturers maintain supply chain continuity and Western economies absorb escalating energy costs. Those energy costs feed directly into inflation. That inflation traps the Federal Reserve. That trapped Fed creates the exact macro environment. Negative real interest rates, dollar pressure, stagflation that has historically driven silver and gold to their most significant price gains. On top of that fundamental backdrop, silver's industrial demand story is intact and accelerating. Solar energy deployment is not slowing down. AI infrastructure, data centers, semiconductors, advanced electronics consume silver at scale. The energy transition is a silver transition. And China, the largest single driver of that transition, just secured its supply chain access through Hormuz while its Western competitors are locked out. Trump called the ceasefire massive life support on Monday. Iran's mines are still in the Strait. Western shipping is still effectively frozen. The negotiators are still deadlocked. And every day the Strait stays closed is another day that the macro pressure on silver builds. $85 today. The question is not whether this moves higher. It is how fast the market catches up to what the data is already showing. ING projects. Gold could reach $5,000 per ounce by year end. Goldman Sachs is at $5,400. If those projections are even partially correct, silver, which historically moves at a multiple of gold in bull markets, has a long way to run. The East saw this coming. They positioned accordingly. The West is still debating whether inflation is transitory. You now have the same information they have. What you do with it is your decision. Invest with logic, not hype. OG out. What if I told you that the exact same move that made early Bitcoin investors millionaires is quietly happening right now in the silver market, and almost nobody's talking about it? Not on CNBC, not on Bloomberg, not in your financial advisor's office, but it's happening. And the paper trail is sitting right there in the public filings for anyone who wants to look. This is OG. You're watching The Asian Guy. And today, we're going to connect three dots that Wall Street does not want connected. Because when these three signals line up, and they are lining up right now, the last time something like this happened, early movers made life-changing money. And the people who laughed at them, they're still paying rent. Let's start with a question. Do you remember 2020? When MicroStrategy, a software company, shocked the financial world by putting Bitcoin on its balance sheet? Everyone called CEO Michael Saylor crazy. Business media laughed. Traditional finance dismissed it as a reckless gamble. And then Bitcoin went from $11,000 to $69,000. MicroStrategy's stock followed. And suddenly, every CFO in America was getting asked by their board, why don't we have Bitcoin? That moment, that single corporate treasury decision, triggered a cascade. Square bought Bitcoin, Tesla bought Bitcoin, and dozens of smaller public companies followed the playbook. Now here's the question that should be keeping you up at night. What if that same playbook, or the exact same institutional accumulation pattern, is now being run on silver? Not as a theory, not as a prediction, as something that is already happening. On April 27th, 2026, 4 days ago, Hyperscale Data, a publicly traded AI data center and Bitcoin mining company listed on the NYSE under ticker GPUS, made an announcement that flew completely under the radar of mainstream financial media. They signed a formal purchase and sale agreement with Scottsdale Mint, one of the most respected bullion manufacturers in the United States, to begin accumulating physical silver, gold, platinum, palladium, and rare earth minerals as Treasury Reserve assets. Let me say that again so it lands properly. A non-metals, non-mining tech company a company whose primary business is artificial intelligence infrastructure and Bitcoin mining, just made physical silver an official component of its corporate treasury strategy. And they didn't stop the announcement. They immediately completed their first purchase, 10,000 ounces of 9999 fine silver bullion, in hand, in vault, real metal. Executive Chairman Milton Alt III said, and I'm paraphrasing here, "Building on our successful Bitcoin treasury strategy, we believe a long-term precious metals and rare earth minerals treasury provides meaningful real-world asset exposure and additional stockholder value." Bitcoin treasury strategy. His words, not mine. They literally called it the Bitcoin playbook applied to hard assets. Now, before you say, "Oh gee, it's just one company, calm down," I want you to hold that thought. Because the reason this matters isn't just hyperscale data, it's what hyperscale data represents. They are the first publicly traded non-metals company to formally integrate silver as a treasury reserve asset alongside digital holdings. Industry observers are already calling it a potential inflection point in corporate treasury design. Inflection point in corporate treasury design. Do those words sound familiar? Because they should. Those are the exact words analysts used in late 2020 when MicroStrategy made its first Bitcoin purchase. And here's what the data tells us about where silver is right now. At the exact moment this corporate treasury trend is beginning, silver right now is trading around $72 to $75 per ounce. But just 3 months ago, in late January 2026, it hit an all-time high of $121.67 per ounce. That's a 40% pullback from its peak in 3 months. Which means if you're a corporation looking to deploy the Bitcoin treasury playbook on silver, you just got a gift. A major asset that proved it could reach $120 is now sitting 40% below that level. That is not a warning sign. For a long-term treasury strategy, that is an entry window. And the smart money, they're already walking through that door. But here's where this story gets genuinely alarming. And I want you to pay close attention to these numbers, because these aren't opinions. These are official figures from the CME Group and the CFTC. Right now, on the COMEX, which is the primary silver futures exchange in the United States, there are approximately 575 million ounces worth of paper silver contracts sitting open. That's the total volume of promises, claims, and bets stacked on top of the physical silver market. And how much actual, real, deliverable silver is sitting in COMEX-approved warehouses available for delivery? Approximately 77 to 80 million ounces. Let me do that math for you out loud. For every single ounce of real, physical, deliverable silver in those vaults, there are roughly 7.5 paper claims stacked on top of it. The coverage ratio, meaning how much real silver backs the paper, sits at approximately 13 to 14%. To put that in perspective, professional silver analysts define 15% as the stress threshold, the point where delivery risk becomes elevated, the point where the system starts showing cracks. COMEX has been sitting below that 15% stress threshold for 6 consecutive months. 6 months without improvement, without relief, and it gets worse. In early 2026, during one single week in January, 1 week, 33.45 million ounces of registered silver disappeared from COMEX inventory. That was roughly 26% of the entire deliverable pool, gone in 7 days. That pool was never refilled. So right now, heading into May, the vaults are smaller than they were before that January drawdown. And the paper claims sitting on top of them, still enormous. Now layer on top of that what's happening with physical demand globally. China's silver imports in early 2026 hit their highest level in 8 years. Chinese importers are currently paying a 12 to 13% premium above the global spot price, meaning silver is trading above $90 locally in Shanghai right now, even while the COMEX price sits in the low 70s, when 2 of the world's largest futures markets are competing for the same shrinking pool of physical metal. Something has to give. The Silver Institute, the most authoritative research body in the global silver industry, has officially projected that 2026 will be the 6th consecutive year of silver market deficit. 6 years in a row where demand outpaces supply. Their projected shortfall for this year alone is 67 million ounces. For context, since 2021, the global silver market has drawn down an estimated 762 million ounces from above-ground stockpiles just to meet demand. That's metal that existed in storage, metal that is now gone. And physical investment demand, meaning people buying actual bars and coins, is forecast to jump 20% in 2026, hitting a 3-year high of 227 million ounces. After 3 years of decline, Western investors are coming back to physical silver in a significant way. On the supply side, total global output is expected to grow by only 1.5%, just 1.5, to roughly 1.05 billion ounces. That growth cannot come close to absorbing the demand increases we're seeing. This is what a structural squeeze looks like before it becomes a squeeze. And here's the thing about corporate treasuries entering this market, and this is the part that I think most people are completely missing. When Michael Saylor bought Bitcoin for MicroStrategy's treasury, he wasn't buying paper Bitcoin. He wasn't buying a Bitcoin futures contract. He was buying and holding actual Bitcoin in custody, the real thing. Hyperscale Data just did the same with silver. Scottsdale Mint, physical delivery, 10,000 ounces in hand. Now think about what happens when more companies follow that playbook. When CFOs start allocating even 1% of corporate cash reserves to physical silver as an inflation hedge and balance sheet diversifier, global corporate cash reserves are in the trillions. 1% of that entering the physical silver market, a market already running a 67 million ounce annual deficit, would create a supply shock unlike anything this market has ever seen. That is not speculation. That is arithmetic. So let's talk about where the money is actually pointing. Because when you combine everything we've just walked through, the corporate treasury trend, the COMEX coverage collapse, the sixth consecutive deficit, the China premium, and you ask Wall Street's top metals analysts what they think silver is worth, the numbers get very interesting very fast. Bank of America's head of metals research, Michael Widmer, has a silver price target of $309 per ounce for 2026. $309. From the current price of roughly $72 to $75, that represents a potential gain of close to 300%. Now, I want to be honest with you. Is $309 the base case? No. Bank of America's model for reaching that number is based on historical gold to silver ratio compression, meaning silver catching up to where gold has moved on a historical ratio basis. It's an aggressive bull case, and bull cases don't always materialize on schedule. But here's what matters. This isn't some anonymous guy on the internet. This is the head of metals research at one of the largest financial institutions on the planet. Citi has also published a $150 silver price target for 2026. JP Morgan, which is historically one of the most conservative voices in precious metals, projects silver averaging $81 per ounce in 2026. That's more than double its 2025 average price. And JP Morgan's Greg Shearer noted that silver's industrial applications make up approximately 60% of total annual demand, meaning this is not just a safe haven trade. This is an industrial supply story and a monetary story running simultaneously. Now, let's ground this in what silver has already proven it can do. Silver started 2025 around the $29 to $30 range. By January 29th, 2026, 14 months later, it hit $121.67. That's a 300+% move in just over a year. Driven by industrial demand, tariff uncertainty, Federal Reserve rate cut expectations, and investment flows. Then came the correction. The Iran conflict drove oil prices higher, which strengthened the US dollar, which hit silver hard. The Federal Reserve's April 29th meeting came in as a hawkish hold. Rates stayed at 3.50 to 3.75%, and the FOMC vote was the most divided since 1992, with 4 dissenting members pushing to remove any rate cut language entirely. Silver responded by extending its decline, which is exactly what creates the current setup. Because here is what the institutional money understands that retail investors often miss. A 40% pullback in an asset that has strong structural fundamentals is not a death sentence. It's a reset. And when that reset happens while corporate treasuries are beginning to accumulate, while COMEX vaults are running thin, and while Eastern demand is at multi-year highs, that combination has historically preceded some of the most powerful rallies in silver's modern history. The gold to silver ratio right now is historically elevated. Gold is trading above $3,200 per ounce. Silver is at $72. That ratio, currently around 44 to 1, versus a historical average closer to 15 to 1, represents either a massive overvaluation of gold or a massive undervaluation of silver, or both. Every time this ratio has stretched to extremes in the past, silver has eventually compressed it. And when silver moves to compress the gold-silver ratio, it moves fast and it moves hard. The 2020 move took silver from $12 to $29 in 6 months. The 2025 move took it from $29 to $121 in 14 months. If the corporate treasury trend that hyperscale data just initiated gains even moderate traction, even 5 or 10 companies following their lead over the next 12 months, the physical demand shock to an already deficit market would be unlike anything we've modeled before. And here's the kicker. Unlike Bitcoin, which has no industrial use, no physical form outside of the blockchain, and derives its value purely from scarcity and network effect, silver has a hard floor of industrial demand underneath it. AI data centers, electric vehicles, solar panels, defense electronics, all consume silver. You cannot print more silver. You cannot mine it faster than the deficit is consuming it. You cannot manufacture corporate treasury demand away once it starts. So what does all of this mean for you, the person watching this video right now? Let's get practical. Because this is the Asian guy, and we don't just report the story. We help you understand what to actually do with the information. First, understand what you're looking at. This is not a get-rich-quick story. This is a structural shift story. The difference matters enormously. Get-rich-quick trades are noise. Structural shifts are signals. And the signal here is that the institutional relationship with physical silver is changing. When Michael Saylor started buying Bitcoin in 2020, he wasn't doing it because Bitcoin was about to moon next week. He was doing it because he believed the fundamental case for a scarce hard asset as a treasury reserve was sound, and that once one credible institution validated the move, others would follow. That domino effect is what drove Bitcoin from $11,000 to $69,000, not one company. The domino effect of corporate credibility. Hyperscale data just flipped the first domino in silver. Now, will every company follow? No. Will some companies get burned if silver continues to pull back short term? Possibly. The near-term outlook for silver in May 2026 is, according to most analysts, cautious to slightly bearish. The Fed is not cutting rates. The dollar remains firm. These are real headwinds. But here's what the smart money does that most retail investors don't. Smart money separates the short-term price action from the long-term structural thesis. They don't panic when silver drops from $75 to $68. They ask, has the fundamental thesis changed? Has the deficit reversed? Have the COMEX vaults been refilled? Has corporate treasury demand evaporated? If the answer to all of those questions is no, and right now, the answer to all of those questions is no, then the short-term volatility is noise on top of a signal. Second, understand what you're not looking at. This is not investment advice. I'm OG. I'm an analyst, a researcher, a storyteller. I'm not your financial advisor. Before you make any decisions with your money based on anything you've seen in this video, please do your own research. Speak to a qualified financial professional. Understand your own risk tolerance. Silver is a volatile asset. That volatility cuts both ways. I'm showing you the data. What you do with it is entirely your decision. Third, watch the dominoes. The story that will tell you whether the corporate treasury thesis is gaining real traction isn't going to come from one company. It's going to come from the second company. And the third, watch for public announcements in Q2 and Q3 of 2026. Watch for balance sheet disclosures from tech companies, energy companies, and AI infrastructure firms adding physical commodities to their reserve strategies. Watch the COMEX coverage ratio. If it breaks below 10%, we are in genuinely unprecedented territory for modern silver markets. Watch the gold to silver ratio. If it begins to compress, if silver starts closing the gap with gold on a historical basis, that compression move tends to happen fast. And watch China. Because while Western financial media is focused on the Fed and the dollar and the Iran situation, China is quietly pulling physical silver off the global market at the fastest pace in 8 years. They know something. They always know something. The bottom line is this. We are potentially at a moment where silver is transitioning from being primarily a retail investor's safe haven trade, something your grandfather bought coins of, to being a legitimate institutional treasury reserve asset. That transition, if it continues, changes the entire demand structure for this market. The deficit was already there. The tight COMEX vaults were already there. The historic price performance was already there. Now, for the first time, we have a publicly traded corporation explicitly citing the Bitcoin treasury strategy as the blueprint for accumulating physical silver. That is a new data point. And new data points, when they represent structural shifts, deserve serious attention. This is OG. I'm watching the market, so you don't have to watch it alone. Invest with logic, not hype. OG out. On May 15th, 2026, just days from now, something is happening inside America's most powerful financial institution that most people don't even realize is coming. Jerome Powell, the man who has controlled the US dollar, interest rates, and the financial fate of 330 million Americans for the past 8 years, is walking out the door. And while Wall Street scrambles to figure out what this means, while American investors sit frozen, confused, and paralyzed on the other side of the world in Shanghai, Beijing, and Mumbai, a very different conversation is happening. They're not panicking, they're laughing, because they already knew, and more importantly, they already bought. Silver is sitting at $74 an ounce right now, down nearly 40% from its all-time high of $120 hit just a few months ago. And to the average American, that sounds terrifying. Another crash, another reason to stay away. But here's what they're not telling you on CNBC. Here's what Bloomberg quietly buried in paragraph 11 of a financial report nobody read. The East didn't see $74 silver as a crash. They saw it as a sale. And while American retail investors were panic selling their silver positions in February and March, while Reddit threads were full of people asking, is silver dead? China's institutional buyers were on the other side of every single one of those trades, buying, accumulating, loading up. This is not speculation. This is not a conspiracy theory. The data is in the numbers, and we're going to walk through all of it today. But first, let's talk about what the Fed chair transition actually means for silver, because this is the part that almost nobody is connecting. Kevin Warsh is Trump's pick to replace Powell. He was just confirmed out of the Senate Banking Committee. And the one thing every analyst agrees on, left, right, and center, is that Warsh wants rate cuts. Lower interest rates mean a weaker dollar. A weaker dollar means commodities go up. And silver, sitting at $74, is the most undervalued hard asset on the planet right now, relative to gold, relative to copper, relative to its own industrial demand fundamentals. The gold to silver ratio right now is sitting near historic extremes. Gold is trading above $3,200 an ounce. That means you could buy over 43 ounces of silver for every single ounce of gold. Historically, that ratio has averaged around 60 to 1. And during major bull cycles, 1980, 2011, it compressed all the way down to 30 to 1. If that ratio even partially normalizes, not even to historical lows, just toward the long-term average, silver doesn't go to $80. Silver doesn't go to $90. Silver goes to $120, $150, and beyond. The East understands this math. India imported a record-breaking volume of silver in 2025, over 8,000 tons. China's solar panel industry alone consumed more silver last year than the entire global mining output could comfortably supply. And yet, the price is at $74. How is that possible? That's the question we're going to answer today. And the answer is going to make you rethink everything you thought you knew about how silver prices are actually set and who is setting them. Because here's the uncomfortable truth that Powell's departure is about to make very, very difficult to hide. The paper silver market, the futures contracts, the ETFs, the synthetic positions traded on COMEX, has been operating at leverage ratios that would make a casino operator blush. For every physical ounce of silver sitting in a vault, there are estimated to be anywhere from 100 to 300 paper claims against it. That system worked perfectly fine as long as the Fed was keeping rates high, the dollar was strong, and Eastern demand could be managed and suppressed. But Powell is leaving. Warsh is coming in. Rate cuts are coming, and the East? They've been quietly pulling physical silver out of Western vaults for 18 months. The clock is ticking. Let's go back to January 2026, because that's where this story really begins. Silver hits $120 an ounce, an all-time high. Every financial news outlet in America runs the headline. CNBC brings on 3 guests in a row who say the same thing. Bubble, overbought, time to sell. And Americans listened. Between January and March, retail silver ETF outflows in the United States were some of the largest recorded in a 3-month period. Regular American investors, the same people who bought silver at $28, $35, $45, dumped their positions near the top, then watched in confusion as the price corrected, convinced they had made the right call. But here is what those CNBC guests didn't tell you. While American retail was selling, JP Morgan's institutional desk was not. The large commercial traders on COMEX, the banks, the funds, the entities that actually move this market, were not reducing their exposure to silver. They were restructuring it. And in Asia, there was no selling at all. The Shanghai Gold Exchange, which handles physical silver and gold settlement in China, reported record physical delivery volumes in Q1 2026. Not paper, not futures. Physical metal leaving vaults and going into the hands of institutional buyers, sovereign wealth funds, and in China's case, direct state-affiliated purchasing entities. India told a similar story. The Indian government, after years of treating silver primarily as a jewelry commodity, has been quietly reclassifying silver in its strategic reserve framework. The word remonetization has started appearing in policy documents, not in the headlines, in the footnotes, in the annexures that nobody reads, but we read them. And here is what those documents say between the lines. India is preparing for a world where the US dollar is no longer the unquestioned reserve currency, where gold and silver play a larger role in settling international trade, where holding physical metal is not a relic of the past. It's insurance against a future that is arriving faster than anyone in Washington wants to admit. Now, let's talk about the industrial side of this equation. Because silver is not just a monetary metal, it is the most electrically conductive element on the periodic table, and the modern world runs on electricity. Every solar panel produced anywhere in the world contains silver. The average photovoltaic solar panel uses approximately 20 milligrams of silver per cell. At utility scale, the kind of solar farms being built right now across China, India, and Southeast Asia, we are talking about thousands of tons of silver consumed every single year just for green energy infrastructure. In 2025, solar alone consumed an estimated 232 million ounces of silver globally. That is roughly 25% of total annual silver mine supply, consumed by one industry. Add electronics, add electric vehicles, add 5G infrastructure, add medical devices, add water purification systems. The Silver Institute, not a fringe blog, the industry's own official research body, projected a structural silver supply deficit of over 200 million ounces in 2025, the fourth consecutive year of deficit, meaning demand exceeded supply for the fourth year in a row. In any normal commodity market, 4 consecutive years of demand outstripping supply would send prices to the moon. Basic economics. Scarcity drives price. But silver is not a normal commodity market because silver has a second layer, the paper market. And the paper market has, for decades, allowed large financial institutions to suppress the price of physical silver by flooding the market with synthetic supply. Futures, contracts, options, ETFs backed by fractional reserves. Here's the number that should shock you. The COMEX silver open interest, meaning the total number of outstanding contracts representing silver that technically should exist in physical form, regularly represents over 1 billion ounces of silver. 1 billion ounces. The entire global annual silver mine production is approximately 800 million ounces. Read that again. The paper claims on silver exceed the entire world's annual mining output every year, consistently. This is the system that Powell presided over for 8 years. A system where the dollar was strong, rates were high, and the mechanism that kept silver artificially suppressed was functioning smoothly. But Kevin Warsh wants rate cuts. And rate cuts, in an environment of active war in the Middle East, record U.S. government debt, and 4 consecutive years of physical silver deficits, do not keep that system functioning smoothly. They break it. And when that paper market breaks, when the holders of those billion-plus ounces of paper silver demand physical delivery and the vaults cannot provide it, the price discovery that follows will not look like a 10% move. It will not look like a 20% move. It will look like 2011, when silver went from $18 to $49 in 8 months. Except this time, the fundamentals are 10 times stronger and the Eastern demand is 10 times larger. The East knew this was coming. That is why they bought at $74. Let's talk about Kevin Warsh for a moment, because the mainstream financial media is covering this Fed chair transition as a political story, a Trump story, a drama about independence and interest rates. But the precious metals market is watching something completely different. Warsh is 56 years old. He served on the Federal Reserve Board from 2006 to 2011, which means he was inside the room during the 2008 financial crisis. He watched what happened when liquidity dried up, when confidence collapsed, when the entire Western financial system came within 72 hours of a complete freeze. And what did silver do during that period? It initially dropped, as it always does in a liquidity crisis, when institutions sell everything to raise cash. Then it went from $9 in late 2008 to $49 in April 2011. A 444% move in less than 3 years. Warsh knows this history intimately. More importantly, Trump knows this history. And Trump has made one thing crystal clear throughout his second term. He wants lower interest rates. He wants a weaker dollar. He has publicly, repeatedly, sometimes aggressively pressured the Federal Reserve to cut rates. A weaker dollar is not a side effect of Trump's agenda. It is the agenda. And here's the thing about a weak dollar policy that nobody on television connects to silver. Every single time in modern history that the United States has pursued deliberate dollar weakness, silver has outperformed gold, not matched it. Outperformed it. In the 1970s, when Nixon closed the gold window and the dollar entered its first major devaluation cycle, silver went from $1.40 to $50. Gold went up 24 times. Silver went up 35 times. In the 2000s, when Greenspan kept rates at 1% and the dollar index fell from 120 to 72, gold tripled. Silver quadrupled. In the post-2008 QE era, gold went from $700 to $1,800. Silver went from $9 to $49. The pattern is consistent across 5 decades of data. When the dollar weakens, silver wins. When silver wins, it wins bigger than gold. And right now, with Powell walking out on May 15th, with Warsh walking in with a rate cut mandate, with the dollar already under pressure from trade tensions and Middle East conflict, we're at the beginning of that cycle again. But this time, there is a variable that did not exist in any of those previous cycles: China. In the 1970s, China was not a factor in global commodity markets. In the 2000s, China was emerging. In the 2010s, China was growing. In 2026, China is the largest consumer of silver on the planet, larger than the United States and Europe combined. And China is not just consuming silver industrially. China is accumulating silver strategically. Here is a number that should reframe everything you think you know about this market. The People's Bank of China, China's central bank, has been on a gold buying spree that is now well documented. They have added over 1,000 tons of gold to their official reserves since 2022. That is public record. What is less documented? What gets almost zero coverage in Western financial media is the parallel accumulation happening at the provincial and institutional level in China's silver market. State-affiliated enterprises, provincial investment funds, government-linked commodity traders. They are not reporting these purchases in the same way the central bank reports gold, which means the true scale of Chinese silver accumulation is almost certainly larger than any publicly available number suggests. And India is not far behind. India's silver imports in 2025 crossed 8,000 tons, a number so large that it represents approximately 1/3 of total global silver mine output. One country, 1 year, 1/3 of global supply. Where is that silver going? Some of it is jewelry, some of it is electronics manufacturing. But a significant and growing portion is going into investment demand. Physical bars and coins held by a population of 1.4 billion people who have historically trusted hard assets over paper currency. This is the part of the story that is invisible to the average American investor, because American financial media covers American markets, American sentiment, American retail flows. They are not covering the fact that 2.8 billion people across China and India are moving in a direction that is fundamentally, structurally bullish for physical silver, regardless of what happens on COMEX, regardless of what the paper price says on any given Tuesday. Now let's connect all of this back to the date that matters. May 15th, 2026, Powell's last day. On that day, or very close to it, Kevin Warsh will take the chair. He will inherit an economy facing stagflation risk, oil prices elevated due to the Iran conflict, inflation not fully tamed, unemployment beginning to tick upward as tariff impacts flow through the supply chain. Warsh faces an impossible situation: cut rates to support growth and risk reigniting inflation. Hold rates and risk a recession that Trump will blame on him personally, loudly, and probably on Truth Social within the first week. Either path is bullish for silver. If Warsh cuts, dollar weakens, real rates fall, silver surges. If Warsh holds, recession fears grow, safe haven demand spikes, silver surges. There's no scenario in the current macro environment where silver at $74 makes fundamental sense 12 months from now. The East figured this out months ago. That is why the smart money, the patient money, the money that thinks in years, not days, loaded up while American retail was panic selling. And that brings us to the most important question of this entire video. Where does silver go from here? Let's talk numbers, real numbers, not hope, not hype, data. Bank of America's head of metals research, Michael Widmer, has a published price target for silver in 2026, $300 an ounce. That is not a fringe prediction from a YouTube channel. That is a formal published research note from one of the largest financial institutions in the United States. Citi, another Wall Street giant, has a published silver target of $150 for 2026. UBS sees silver pushing back toward $100 in the near term before any meaningful correction. Even the most conservative institutional forecasts, the ones that assume no Fed rate cuts, no dollar weakness, no escalation in the Middle East, still see silver returning to triple digits before the end of this year. Now, silver is at $74. Do the math yourself. From $74 to $100 is a 35% gain. From $74 to $150 is a 103% gain. From $74 to $309. If Bank of America's thesis plays out, that is a 317% gain from current levels. When was the last time your savings account offered you 317%? When was the last time your bond portfolio offered you 103%? This is the conversation that the East has been having at every level, from institutional fund managers in Shanghai to middle-class families in Mumbai stacking physical silver coins in their homes. And this is the conversation that most of America is completely missing. But let's be honest about the risks, because this channel does not do hype. We do analysis. Risk number one, the dollar strengthens unexpectedly. If Warsh comes in and surprises markets by being more hawkish than expected, holding rates higher for longer, the dollar could rally and pressure silver in the near term. This is a real risk. It is also, given the current debt trajectory of the United States government, a temporary one. You cannot run $2 trillion annual deficits and maintain a strong dollar forever. The math does not allow it. Risk number two, a global recession crushes industrial demand. Silver's industrial component means it is not purely a safe haven. If global manufacturing contracts sharply, solar installations slow, EV production drops, that affects demand. However, and this is critical, even in the 2008 recession, silver's initial drop was followed by a 444% recovery. Industrial demand weakness creates buying opportunities. It does not create permanent bear markets in silver. Risk number three, paper market manipulation continues. This is the risk that keeps silver suppressed the longest. As long as large institutions can flood COMEX with synthetic paper supply, the physical price discovery mechanism remains broken. But here is what is different in 2026 versus 2016 versus 2006. Eastern exchanges, particularly in Shanghai, are increasingly settling silver in physical terms. Every ounce that leaves a Western vault and moves east reduces the paper market's ability to suppress price. The physical drain is real, it is ongoing, and it is accelerating. So what should you actually do with this information? This is not financial advice. I'm not your financial advisor. You need to do your own research and make your own decisions based on your own situation. But here's what the data says. Here's what the institutional positioning says. Here is what 8 years of Fed policy history, 4 years of physical silver deficits, and the largest Eastern demand surge in recorded history says. Silver at $74 in May 2026, with a new Fed chair walking in with a rate cut mandate, with the gold to silver ratio at historic extremes, with China and India absorbing 1/3 of global mine supply between them, is not a broken commodity. It is a coiled spring. And the trigger, Powell's departure, Warsh's arrival, rate cuts on the horizon, is already in motion. The East knew this was coming 18 months ago. They positioned accordingly. The question now is not whether silver moves. The question is whether you understand why it moves before it does, or after, because after is always more expensive. This is OG from the Asian guy. Do your research. Question everything. And remember, invest with logic, not hype. OG out. Silver just dropped $12 in 3 days. $12 in 3 days. And here's what nobody on Wall Street is telling you. The moment that price dropped, phones started ringing in Shanghai, in Beijing, in Mumbai, not to panic sell, not to ask questions, but to buy more of it. That's the story Wall Street isn't covering. And that's exactly what we're breaking down today. Let me set the scene for you. Just last week, silver was riding one of the most powerful momentum waves we've seen in months. The Trump-Xi-Beijing summit had just wrapped up. Trade war tensions were cooling. And silver, which had already been on an absolute tear in 2026, spiked hard on the news. It pushed past $88 an ounce. Investors in the West were calling it the beginning of a new leg up. Financial media was buzzing. Everyone was excited. Then it dropped. $88 became $82. Then $79. Then $76. In 3 trading days, silver gave back $12 per ounce. And the same financial media that was cheering it up went completely silent. Or worse, started writing, "Is the silver rally over?" headlines. But here's what they missed entirely. While Western retail investors were panic selling, refreshing their brokerage apps and doom-scrolling Reddit threads, Eastern buyers didn't even blink. In fact, according to physical market data, buying activity out of Asia actually increased during the dip. Not decreased, increased. And you have to ask yourself, why? Why would sophisticated buyers in China, India, and Southeast Asia aggressively step into a market that just fell $12? Why would they not wait? Why would they not panic like everyone else? Because they know something. They know that this drop has nothing to do with silver's fundamentals. Zero. The structural story that has been building for years didn't change in 3 days. Silver is still in its 6th consecutive year of supply deficit. The physical market is still structurally tighter than most Western investors even realize. Industrial demand, from solar panels, from EV batteries, from AI data center infrastructure, is still climbing. None of that changed. What changed was sentiment. Western sentiment. That's it. And Eastern buyers understand the difference between sentiment and fundamentals better than almost anyone on the planet. They've been watching the West confuse the two for decades. So when the West panics and the price drops, the East sees a clearance sale. And let's talk numbers, because that's where this gets really interesting. Silver hit an all-time high of $121.64 on January 29th, 2026. That was historic. That was the white metal breaking through levels nobody had seen in over 4 decades. And since that peak, silver has pulled back significantly, sitting now at approximately $76 an ounce. That's a correction of nearly 37% from the all-time high. Now, in the gold world, a 37% correction from a peak would send investors running for the exits permanently. But silver isn't gold. Silver has a dual identity. It's both a precious metal and an industrial commodity. And when the price corrects in silver, it doesn't just attract investors, it attracts manufacturers. It attracts industrial buyers who are now locking in cheaper input costs. It attracts sovereign wealth funds that have been waiting for exactly this kind of pullback. Gold right now is sitting above $4,500 an ounce. The gold-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, is sitting at approximately 55 to 1. That ratio compressed from 62 to 1 in a single week earlier this month. One of the fastest compressions in years. That's not noise, that's a signal. Here's what that gold-silver ratio actually tells you, and why Eastern buyers understand it fluently while most Western investors have never even heard of it. When the ratio is high, say 80, 90, even 125, like it was during the COVID crash of 2020,